Today, I'm going to walk you through every aspect of how to construct a profitable trading strategy. From journaling and what to study, to planning out and selecting trades, and even how to execute them once you find them. Everything I show you today is going to be relevant to whatever you trade. Crypto, futures, forex, you name it. By the end of this video, it is my promise to give you a blueprint, the same blueprint that my mentors passed down to me when I was learning under them. And the concepts and bigger model I show you today, a part of this blueprint, is not just up for debate of whether it might work or it could work. These are tried and proven concepts that I learned from professional traders that worked with me for nearly 6 years of my life. But before we dive into the 3 major sections of how to actually build out a profitable trading model, we first have to talk about what is a good trading system. Because if we can clearly define this, it makes it so much easier to know how we should build these models. A good trading system is not just a system that makes money. A good trading system is one that you can rely on in any market condition. Markets are always changing, and for us traders, if we want to stick around for a long time, our systems need to be able to adapt to that. And we can look back in history and see, even with some of the most legendary traders, examples where this painful truth that if you don't adapt, you won't make money is true. In the 1990s, legendary trader Blair Hall started a trading firm and really went ballistic, achieving multiple 100% plus returns for the firm year over year. He ran a bigger market making strategy book, which meant most of his trades were quantitative and not really discretionary, like looking at charts. And in 1999, after several years of 100+% returns, Goldman Sachs came in and bought them for $500 million. One of the biggest sales of a trading firm ever. However, there was one big problem. From 1999 into the turn of the century, being 2000, the markets were largely going into a computer-based system. His technology and his edge was slow and becoming behind the curve. Goldman Sachs didn't see this, and just within a few years of buying it for over $500 million, the firm went unprofitable entirely. And even just a few years later, Blair Hall came back, not to that firm, but made his own new firm, and he found that his edge was completely dissolved. He himself couldn't even trade the same strategy anymore. Now, while he does deserve all the praise he gets for his prime in trading, it's a painful reminder that if you don't have a system that adapts, the markets don't care who you are. If you can't keep up with them, they're not going to come back for you. So a good trading strategy is not only one that can adapt to any market condition that we can rely on, but a good trading system is one that is efficient, not only in the amount of time we spend on it, but also the opportunities that it selects. I think you and I can both agree that going through every single ticker in the stock market alphabetically is not a good nightly routine to finding trade ideas. And while this is a silly and extreme example that I'm sure no one does, there are many people out there that are doing very inefficient things such as that on a less extreme level. Now, the third defining factor of what makes a trading system good is that a system is reliant on the mechanics or the processes of the market. Let me explain. Let's just say you're a trader who purely trades Elliott waves or patterns. You really don't look at anything else. Well, that's not relying on the market mechanics. There's no rule in the market that says a pattern has to play out, and there's no real rule that says this Elliott wave structure has to follow some wave structure that you learned. Why? Because underneath the hood, there's no process that says that's a rule. However, there are processes that are typically defined as rules or facts in the market. For example, if you have a large area of puts, as a market comes down into that, market makers are going to start having to buy back shares on any bounce off of that put level, which ultimately helps drive and increase the velocity of buying pressure off of it, making large area puts support levels. That is a mechanical process that will never change and is a somewhat written rule in the markets, because not only do market makers have a legal obligation to do this, but it's also in their best interest to achieve balance, which is how they make money. See how that's a lot different than just noticing a shape in price action and trying to say a market's going to do this because of it? Now, I'm not saying technicals aren't important. We'll talk about this later on in the video, but my point is that market mechanics, or how the markets actually work, need to be infused in your decision-making process when you're selecting trades with a good trading system. And the fourth and defining factor of what makes a good trading system is that a trading system is a perspective and not just one strategy. See, a good trader knows multiple strategies. And going back to our first few defining factors, if you have multiple strategies, it will make it much easier to adapt to changing market conditions that might call for one strategy or the other to make better trading decisions. We as traders cannot be one-trick ponies, at least for very long. Think back to Blair Hall. So in order to stick around and adapt to markets, we have to have a toolbox that we bring to each job site that has multiple tools in it that we can fix maybe the same problem, but different ways. And so your trading system really needs to be a perspective made up of multiple strategies that are harmonious and can work in unison to develop trade ideas. While it is easy to define a good trading strategy as just one that makes a lot of money, that doesn't doesn't help someone, especially you, who are just starting out trying to build a profitable system. Because making money is an output. All we can control as traders is the input. So setting a goal such as we want to become more time efficient, that's something we can do on our end. And that's why it was important for me to define what a good trading system is. Now I want to shift our focus of this video into the three major sections of a trading system. That being journaling and academics, planning, and executing trades. Throughout the journaling and academic section, we're going to talk about how you should be journaling trades, because believe me, a lot of people are doing it wrong, as well as how you should be studying material on a daily basis. In the planning section, this is where I'll break down the mechanics of the market to you, as well as how to build what I call a funnel, which is crucial in selecting good trading opportunities. And finally, executing trades. This is where we'll talk about entries, position sizing, and exits. We do all this work before trading. When you do step up to bat, this is how you're going to swing when the ball comes right down the middle. Now, the first section, journaling and academics. First, we're going to start with the do's and don'ts of journaling. And I'll even show you how I personally journal my trades. Now, really, what is the purpose of journaling? Why do we traders need to prioritize this? Is because, well, it's a great way to reflect upon your actions. If you don't write it in stone or reflect on your actions in a proper setting, then you're not ever going to really learn. With how fast-paced the markets are and how quick we go from trade to trade, if we don't reflect upon our trades, it's easy to forget the lessons that we should have learned from one to the other. Really, the first thing you need to journal is a software, either GoodNotes, which is what I use, Notion, PowerPoint, Docs, or Slides. One of those where you can paste an image in and easily type is going to be your go-to. So now that you've chosen a software, which I'll show some examples at the end, what they look like, but let's say you choose a software. What you want to do now is define your journaling objectives. And I think the easiest objective you can just start with is journaling your mistakes, not what you do right. Only want to focus on your mistakes. That's it. The purpose of journaling is not to glaze yourself in how well you did with this trade and how big of a P&L it was, because the reality of it is that P&L is somewhat of a lie. You could do everything wrong in a trade from a systematic perspective, or even you could have just got really lucky and yet you still make a lot of money. And the opposite is true. You could do absolutely everything right. You could have entered at the right location. You could have held according to certain risk parameters. You could have done everything right and still not made money on a trade. So P&L is not a good reflection of a trader's ability or a good progressive path for you to learn down. So what you should be focusing on is purely your mistakes. You shouldn't really be journaling until later on what you're doing right, because you won't really know what you're doing right because you don't have a system. The only thing you can try to do is notice a mistake and then correct it. Okay, so you're going to be journaling and you're going to be looking out for mistakes. What else should you include in your journaling? Well, a call to action. That each trade that you journal, you need to have a call to action. And what that means is right after that or during that journaling process, you are going to go and do something to try to correct it. It could be that you're unfamiliar with a concept, so you go and try to study that one concept for the rest of that night. Or you could just say, you know what, I need to remember that because I forgot in the moment. So what I'm going to do is I'm going to get out a Post-it note and I'm going to write down, make sure to do this. Post it right underneath your computer screen. That way, when the next time comes around, if you have another mistake and you forget, guess what? You need to find a better way to remember that. Maybe the Post-it note didn't work. So now I need to set a reminder on my phone or something on my chart that's literally right in front of price action, right? So with each journaling entry, you need to have a call to action. And again, it's to correct a mistake. We don't care what you did right. You know what you did right. Us humans instinctively know what we do right, but we don't necessarily always know what we're doing wrong. And kind of the final point you want to include in your journaling is classification of your trades. I can't tell you how important this is, but as you move forward, especially in the later parts of your trading career, not necessarily at the start, it'll be very hard. You want to begin to classify trades in A, B, C, or different maybe numerical values. But you want to know what trades are typically your bread and butter. Which ones do you actually perform well on? Which are the ones that sometimes work but aren't worth necessarily a big position size? If you classify your trades, for me it's ABC, then that over time will help develop you and understand that what trade am I looking at on screen right now? Is it going to be one that I put this amount of position size on, or this one? How much am I willing to hold? How much am I willing to risk, etc., etc.? Because a lot of you guys unknowingly do this, that you'll see a C setup that you actually don't really find works out all that much, and then you're going to put the normal position size you normally do on it. And that's why you guys always have these nice winners, but your losers are so much bigger. It's because you're always over positioning on trades that don't deserve that amount. So classification is incredibly important, but you likely won't be able to do this until you get later on in your career, because again, you need to have a sound understanding of your system to begin with. And finally, I kind of just have to include this because you would be surprised how many people fall victim to this. But when you're journaling, you have to be brutally honest with yourself. I cannot tell you how many people I see that are like, hey, can you check out my journaling? And then I look at their journaling and it's just another outlet for them to boost their own ego. It's crazy. And many of you watching right now might not admit this to yourself right away, but you might actually see it if you're honest to yourself, that really when you hit these good trades and these big P&Ls or these bad ones, you're either blaming the market, you're trying to say, oh, I did so great on this, when in reality, you know you didn't, and that you don't have a system that's great. So when you're going through journaling, the last point I want to make is that you have to be brutally honest. You cannot let this turn into a self-cheerleading program where you just boost your ego. If you're not willing to be honest with yourself, believe me, there's no room for growth. Stop trading now, pack it up. So let's do an example of how I would journal a trade. I'm just on Google Slides. I don't use it, but I can just prove to you guys that you can really use anything as long as you stick with it. So this right here is Google Slides, just trade review, simple. It doesn't need to be fancy. Right here, I have just the ENPH trade, 112.25. And what I've divided the slide into is before and after. So of course, when I find the trade idea, I'm going to fill out the before. What I'm looking to do is incorporate my inputs. What am I thinking behind this trade? Why am I thinking it? It's important to put your thoughts down to paper before you take a trade so that you know without hindsight bias what you were thinking at the time. And of course, I do this on the RADER report every week, so I don't really have to look that hard because I typed this beforehand. So my input, of course, would be something like this flow trade here. And the thinking behind it was this. Boom, maybe I type in a few different paragraphs, so maybe I include this as well, something like that, but also a seasonal. So, of course, you guys would be typing this out, but since I've already done it, I don't need to, since it's all right here. And then what I'm going to do here is then maybe I include also, which is super important, the chart and analysis I was thinking behind it. What was I thinking? What was the chart I was looking at? Things like that. Okay. So again, it would look more neat on yours than mine. But since I've already typed all this stuff, it's important to have the pre-analysis before you actually take the trade. So with that being said, I also have here the setup that this is a hedge order of flow, and typically that's a really good A setup for me. I typically do very, very well with hedge orders. So this is, to me, is an A setup. And so guess what? When I'm on trade review and I'm going to go look at my A setups, I can Control F, A setup. And it will bring me to all the A setups in the future, right? And so this way you can go through and Control F, quickly find data as you build this up over the years. So right here, what you're going to do is you're going to have your before, and then after, what you're going to do is this is where you're going to really incorporate what we talked about. You're going to identify your mistakes. You're not going to really worry about what you did right because you're not going to know that at the start necessarily, but also you're going to have a call to action. So I can tell you right off the bat that BAX, this was a really good trade. And, we can say that in hindsight that it did really well, but again, we don't care. I made money on this trade. It did really well. But again, all we care about is the call to action. And so we can post the chart here. You can say on the chart, where you got out, where you got in. So I would just do a little marker on TradingView or something. Hey, I got in here and I got out here. It's that simple. What was your position size? Maybe things like that. So, you type out your position size, what you did, your exit and your exit. Okay. And you're just going to be brutally honest with yourself. And you're going to say, hey, look, was this luck? Did you really know what you were doing going into this trade? Was it something that just fell into your lap? And for me in this trade, I can tell you, I remember when I journaled this in my iPad, that BAX, I did not add enough position size. This was a major mistake of mine. And again, I'm not going to care about what I did right. I know what I did right in this trade because I typed it all out here and, I knew what I did right in this trade. But one thing I know I didn't do right was I did not add enough position size to this trade. And I say that not because, oh, look how big it went. I should have added more so I could have made a gazillion dollars. No, the reason was that it went in my favor and I did not add past the first target, which I typically do with a stock with this much momentum. So I would be brutally honest with myself and I would say, hey, look, BAX, I did not add enough position size. It had a lot or a significant amount of momentum. Should have added, you don't have to say the exact contract amount because that varies, but you should have said should have added more. And so that's a general idea. Now, you have to have your call to action, okay? And this is going to be important to how you journal. But it's going to be, okay, so you have this problem. How are you going to go fix it for the next trade? Or so if another hedge order comes up or any trade order, what is it going to take for you to fix this? Well, you could say number one, something like this, right? That, okay, I struggled with adding with this stock with this much momentum. So maybe I just do a post-it note, because I normally do this. This is something I normally do. I do normally add when there is this much momentum, but for some reason this time around I forgot. So maybe I make a post-it note. Or if this is a problem you've encountered for the first time and you're like, well, wait a minute, that's an interesting question, that how I should have added more because of how much momentum it is. Now you need to go measure momentum, so that when you see a stock like this, let's say we set a rule that, if it's greater than 1.2 deviations out, right? That if a move exceeds 1.2 deviations, which is, if you guys don't know, like the average price action trades within this, if we exceed 1.2 of that, that signals a lot of momentum and I should add. Or maybe it's something as, adding at target 1 reminder, right? That you would add at target 1 if it did have 1.2 deviation. So this is what you're going to work through. And of course, I can't do this. I can't walk you through step by step because I don't know your trades. But I can show you that this is how I do it. And that, on a different form on my iPad. But it is essentially the same thing, that I grade the setup. I have the trade here, I put the date, and I have a before and after. And this way, when you go back and you say, okay, 1 year from now, if I look back at this trade, am I really good at hedge orders, or am I really bad? Because that's going to help you classify them. Build up a catalog over the years and you'll say, hey, look, I kind of suck at trading hedge orders. And maybe I like discount orders on flow, or maybe I'm a more seasonal trader. I like seasonal charts better. And that you'll find over the course of many, 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 many trades what you typically are best at. And you'll fall into your niche. But again, it's important to have a system, a toolbox, that you're not just a one-trick pony. And that's why you grade these setups, is because sometimes C setups can pay way more than an A setup. But C setups don't, have as big a position sizes. But sometimes those go 1,000%. Sometimes those go 2,000% trades. And so that's why you still need to have them. You still need to have them in your toolbox. So again, grading, trade ticker, the date, and a call to action, along with just a simple analysis of here's where I got in, here's where I got out. What did I do wrong? Notice how I'm not talking about my P&L. I don't care, because I know what I did right. I know what I did wrong. But you need to talk about what you did wrong. That is the most important thing. And for example, if this was a losing trade, what you would have done is maybe talk about, was it a massive losing trade? Did you add on the way down? Well, then you're like, okay, well, I need to obviously not add to losers. That's a bad idea. Not going to add to losers. And your call to action is going to be what? Well, you're just going to stop adding to losers. That's your call of action. You are no longer going to add to losers. And if that turns out that doesn't work as well, then you need to shift and try something else. Now, again, there are other softwares you can use. I just built this little demo on Notion. This is probably a good one where you can put, like, for example, the ticker. You can put the date that you held the trade, even the day of the week or something like that. Did it work? Did it not? What was the gain? Was it a loss? Still active? Things like that. Trade before, maybe some trade notes you have along with it. This is also an acceptable software, and this also allows you to control F and search for, hey, I want to look for stocks that I lost on or stocks that I gained. Maybe, loss. Was it a loss? I want to find out how I'm losing. Maybe look into the trades that I'm losing more on. Are they hedge flows? Are they seasonal trades? Are they these other ideas? Whatever software you pick, make it an efficient system that you're willing to do. I can't tell you how many people have what's called tomorrow syndrome, as they say, oh, I'll journal tomorrow, and then they never get to tomorrow. Tomorrow's a fantasy land. Only things can happen today. And so when you're doing these, just find something that makes you comfortable, that makes you happy to go journal, and that doesn't seem like a chore. Now, the software I personally use, again, is GoodNotes. I think they're like less than $10 a year, but I do it on my iPad. The reason I do journaling on my iPad is so that I separate it from where I'm actually trading. It's not really a mental thing. It's just so I can always be wherever in journal versus, sometimes you always can't be on your computer with Google Slides. And, on the iPad, Google Slides is pretty buns anyway. So I recommend GoodNotes for any of you iPad users who like that, but that's typically the software I use. They have great folders, great organization, and you can easily copy and paste images and things like that. Also, you can have it on the computer if you want it, but I typically just prefer it on iPad. In the second part of this segment, journaling and academics, what I really want to focus on is not necessarily what to learn, as that's going to be in the next section, but I want to focus on how you should learn. What should you kind of be utilizing to learn? Because a lot of you are not doing it in a very efficient way. The first thing I should discuss is, while it's not bad to read, I want you guys to understand that buying books is useless in 2025. Number one, half the books you're buying are found free online, whether I support pirating or not. That's just the reality. But also, books are very, very limited in what they can provide you. There is so much more available information on the internet at your fingertips for free than there is other places like buying a book. What I see too much of is people ask me, Raider, what books do you recommend for trading? Just because it's a book does not mean that there's more knowledge. There's this misconception that books have more secret knowledge within them than online, and that's just not true. While there is a lot of garbage online, there is also unlimited amounts of really good resources. Now, I don't want to say the books are completely useless. There's not. There's some good ones out there, but as far as majority of the information you're going to be learning, it's going to be found online. And that leads me to, what financial or market literature can you read on a daily basis? Well, I actually recommend the Wall Street Journal. If you go to Barron's or Wall Street Journal, they have a complete package where you get like Wall Street Journal, Barron's, IBD, Market Watch, all in one subscription. And what that gives you is virtually unlimited research. You can just go and you can look at different articles and things like that. And these are daily updated. These will keep you in the current flow, the current state of the markets, and constantly seeing new opinions. Now, fair warning, majority of the opinions online are complete trash. A lot of articles that you will see throughout Wall Street Journal and other places are going to be, why this stock is cheap, buy now. You don't want to click on that article. It's better to click on an article that says why the Trump tariff might affect the dollar. That is a much more important article and probably presents some data points that is actually valuable to you, and you might actually learn something. Over time, compounding these different articles of reading different research, remember, only listen to people who provide you with research and facts to back their answers. That's going to lead you down a more profitable and educational path than just reading opinions of why Tesla is cheap. But I can't stress this enough, that staying up to date with current market literature is going to keep you in the loops of the market and help you spot overall themes. They're not going to give you direct trade ideas, but what they'll give you is kind of the theme of the market. What is it that Wall Street is thinking about? What are the broader concepts that they're worried about? For example, if everyone's talking about the Trump tariffs affecting the dollar negatively, then that's something to consider, that, hey, maybe if the dollar does start this more multi-year decline, that we want to look into something like commodities and we want to look into something like precious metals to take trades on. Now, I do briefly want to show you guys some examples of what it's like to go through some of these articles, so at least you know the ones that are the most beneficial. So when you're reading this literature from day to day, you can actually get benefit from it. So right here, I'm on the Wall Street Journal, and what you'll notice is on the front page or even the print edition, a lot of it has to do with Trump. Now, you have to understand, from a business perspective, Trump headlines get a lot more clicks. And while they're not all kind of necessarily related to the market or impactful or stuff you should be reading because they are political pieces, it is important to see that occasionally you will find like an article that says Trump is changing the world over unprecedented speed. And you can see it mentions specifically healthcare, schools, and global supply chain. So something like that would give you a nice broad overview of maybe there is some value that, you can take away from that. But really what I want to highlight here, at least on the Wall Street Journal, and then we'll look at Barron's, which is my second favorite. You can see right here up at the top, there's a bunch of different tickers. There's like the dollar, the Dow Jones, the S&P. If you actually click on one of these right here, the Russell 2000, you can see that there's headlines specifically related to small caps. And if you see right up here, or something to do with the Russell, you can see it says right here, it takes more tariffs and DeepSeek to keep the stock market down in 2025. So that's interesting. You can go, okay, I'm going to click on this, and it'll actually bring you to Market Watch because they're all under the same umbrella. And so right here, what you'll notice is, you can kind of briefly skim through this. Just so you don't waste your time. You're looking for data, and you can see that right away I can see some different charts, things like that. That's something you want to go to. Right off the bat, you can see total put to call ratio and sentiment gauge. Okay, cool. So I'm going to read this article. And as you go through that, you'll see opinions that are actually backed by market facts. You do not want to, again, look at stocks or articles that are like, hey, this stock is cheap, why you should buy. Those are paid pieces, likely by a company or a related company to try to get more people to invest in the stock. Those majority of those pieces are worthless to you. You want to see broader market data-backed opinions. You do not want to hear the opinions of someone why he thinks a stock is cheap. You would rather listen to an opinion on why someone might think a market could see turmoil in the future based off of these factors. that is going to make you a much smarter and much more literate financial thinker, especially when it comes to markets and investing. Now, my second favorite website is actually going to be Barron's. Again, these are both related, but what you can see right here is top stories and latest under the homepage. I normally just go to latest, and this gives me just the brief titles that I can see, and you can see, oh, Trump wants to, reciprocal tariffs or on any country, what that means. That could be something that Austin, you don't know what that word means, so let's go and learn about that. You could do that. Whether that has an effect on the markets or not is not necessarily always going to matter, but you do want to try to look at articles that are, something related to a market that is backed by facts. So, for example, something that you probably didn't want to waste your time on, you can see this article right here says, a new accounting rule offers fresh insights into public companies. That's really not necessarily something you want to necessarily care about because it's not really going to matter to you as a trader. But as far as other things, what I like to do on Barron's is if you actually go click on this middle one, it says interest. It actually brings you to this wider bubble of different articles from bonds, ETFs, financial planning. Obviously, we wouldn't do that. Testing, technology. And if you scroll down, there's so many different kind of categories. There's healthcare, there's airlines, and you can go and target your research. Say you want to learn about, the recent healthcare titles, or you want to look at what they're saying about airlines, things like that. That is what you can do. It's more targeted, it's more efficient, and it allows us to actually get to the information we want as traders, which is seeing data and supporting different ideas and theses that can lead us down different paths. Now, over time, if you read these articles enough, you will catch on to some different correlations and things like that. Like, how would the dollar affect the markets, or how would tariffs affect different commodities and things like that? That will stick with you for probably the rest of your life. And who knows, might actually come useful later on when you're adapting to a different market condition. Now, the last portion I want to talk about within the academics portion of this section, how you should be learning. Again, not what you should learn, but how you should be learning is really videos and the content that you absorb. And with that, we're going to play a funny, silly little game. So up on screen right now is a thumbnail, and I'm going to show both of them. So here's the other thumbnail right here, and you have the choice. Which video are you going to click on? The one with the dream car, $25,800 profit day in trading, or are you going to click on the thumbnail or video titled How Options Influence the Underline, with maybe a boring thumbnail? The point of this exercise is a lot of you guys, as much as you'd like to laugh at this experiment, would probably click the dream car one. Although the thumbnails are less dramatic, you guys, proven by the amount of views majority of these videos get, would rather see a lot of the lifestyle of trading. You want to see people making money, and you validate people by their status, their lifestyle. Oh, Raider, you don't make money trading if you don't drive a Lambo. All of that stuff. You'd rather see the lifestyle and status, and so you get intrigued and roped into these different people than actually seeing meaningful material. And that a video that might have a dumb, boring looking thumbnail, because maybe that person is super intelligent, but they just aren't good at art. They don't have a promotion team trying to pump out as many views as possible because they don't care. They just want to share a concept. So the point is here, when you go and you look for material, a lot of you guys are blurring the line of entertainment and learning. Make sure that you cut off entertainment. The purpose of you watching YouTube videos is to learn, not to necessarily entertain when it comes to trading. So videos like this one that are over an hour, at least that's what this video is planning to be, it's not really to entertain you. And while I hope you do have fun learning, you don't necessarily want to go out in the YouTube video sections and look for videos that are, oh, he's so silly, he's got such a funny personality, he just makes all this money. You guys aren't going to learn anything. And you certainly won't beat a $100 trillion market if you continue down that path. So when you look for videos in the future, try to look for more complex videos. Try to look for things that you don't understand and not just look for trading videos that make you feel warm inside and are entertainment to you. You are not going to learn anything from the guy flexing his Lambo on YouTube who sells a $5,000 mastermind course. You guys know exactly who those people are. The people who lie, the people who are frauds, the people who go out in this industry with one goal, to make money for themselves off the idea of trading rather than actually trading themselves. So moving forward, stop judging the content based off whether it's entertaining. Find the videos that are boring. Find the videos with the hard topics, because no one is watching the really valuable ones. And just to prove this point to you guys, if you look up something like seasonal trading, which historically has been one of the most profitable trading strategies in history, you look at these, the top videos are 5.8K view, 15K view, 12K, you go down and there's just literally less than 100K views on all of these videos. Even my video comes up. Whereas if you type in something like ICT trading, you will see millions of views. Someone who's proven to be honest with his audience, someone who's never produced any sort of professional quality material. That is something you want to avoid. You don't want to follow the crowd in that sense. And I'm not just saying follow me, but what I can tell you is that the more profitable concepts, the stuff you should be learning, has less views. So don't let the amount of followers, don't let the image of the trader, don't let the amount of views the video have or the thumbnail influence why that video is bad. And again, separate entertainment from learning. So far in this video, we have defined what a good strategy is. We've also outlined how to journal and how to learn, at least from an academic standpoint, as you progress through your trading journey. But now this portion of the video is going to be the meat on the bone. In this portion, I'm going to show you what I use to build out my strategy and the concepts with that, as well as explaining how I believe you should be modeling your strategy using what I call a funnel, which ultimately can lead you to better, higher edge trades. This is the building and planning portion of this video, and how I built and planned my strategy under my professional mentors was by studying what's called market mechanics. Market mechanics are hands down one of the most profitable trading concepts that you can implement into your trading. It's not some magical 1, 2, 3 step thing, but it's these general concepts that blend together that give you an ultimate view on the market. The core principles of market mechanics I've narrowed down into 4 categories, those being technicals, seasonals, rotations, and the options market and option flow. While this is not going to be a complete explanation of every detail related to each one of these concepts, I'm going to do a broad overview of each and then show you how to actually implement this into a funnel and model. The first mechanic of the market is going to be a technical perspective. And this is just understanding, how do we read charts? What is the purpose of charting? Because many retail traders get this wrong. So first of all, what is the purpose of charting? Well, to me, and what I was trained under my mentors, the purpose of charting is really where we map out risk. It is not necessarily to be used independently to find trades, because price action lies. How does it lie? Well, I always give this experiment, and if you want to see more on this, you can definitely check out this video right here I'll show on screen. It's one of my most viewed videos. But right here, let's say we have 2 price action setups. These are virtually the same. You have a range, that was broken with a big red candle right here, range that was broken with the big red candle here. Many of you are going and you're trying to look at a stock like this, not knowing that a similar setup like this, almost the exact same price action, exists. And you think, oh, well, this setup looks really good, so I'm going to long this for the dip buy. But how do you know that this setup, out of the hundreds of thousands of setups that look exactly the same as the one that you are looking at, how is it that you know this one is going to work out? Well, wait a second. It can't just be by price action alone, because there's hundreds of thousands of different setups that are almost the exact same across different time frames, different assets. And so what that means is that we have to refer to everything else to lead us to a chart to validate why that stock will continue to move in the future. And just to reemphasize this point, let's say we have 2 price action setups that look like this, literally the exact same. One could be on a different time frame, whatever. But the point is this, that if you're just looking at price action alone and I say, which one would you long, you would be confused. Well, I don't know. I couldn't tell because they're both the same. Well, right. But what if I told you that this one, for example, is XLU and this one is, like XLK, like tech? Well, wait a second, that puts a different premise on it, because if the markets are weak, then something like a defensive name might get a bigger rotation and therefore go up, while technology would remain flat or if not drop. Even though both have the same setup, their risk outcomes, the outcomes of those stocks, the expectations are completely different just from the ticker alone, just from the flow alone, just from the seasonal period you're in. All of that matters and builds into a chart. So that leaves us with this. If technicals don't generate trade ideas by themselves, then all we really have to do is worry about that we're drawing them correctly and that we're really interpreting the charts correctly. And therefore, I've divided technicals into 2 sections: liquidity zones, which is, are you spotting zones correctly? And then also just the laws of charts. This is a very important one, and I'll get to that in a second. But the best way I can show this is through kind of a little presentation that does a broad overview. The more specific examples I will show you later on when we review some of the RADER Report trades and how I actually built a lot of these ideas without hindsight. You can see right here that liquidity zones and laws. The first kind of section of this is the liquidity zones. There are thought to be 6 liquidity zones, at least that I have made, that are most common in the markets. And you might ask yourself, well, RADER, why is there 6 different zones? I thought all you need to know is 1. Well, it turns out that price action, while it does never repeat the exact same, it does rhyme. that famous saying, history rhymes. And therefore, price action, it's always telling a slightly different story. But if you do look at price action, there are common structures you can expect or common occurrences that do indicate that that is where liquidity is. And that might look different from, an expansion zone to pressure level to third deviation. How we come to that zone, how we get that zone, that might be different, but the same principles apply for all of these zones. The liquidity laws, how they work, it's all the same. But the shapes that we're looking for or the structure in the market we're looking for is different in where we kind of place these zones. So first of all, the expansion zones. Expansion zones, again, I reviewed this in my technical video not too long ago. Expansion zones forms when a gap plus a candle violates a prior key level range and forms a directional move. You would draw that from body to body on the first day after that gap. I typically draw this on the daily candle. There is an exception if that candle is super big. We'll get to that. But that is a liquidity level. So going to an expansion zone, this is an example. Right here, what we have is we have some sort of predefined range. Again, you need some sort of predefined range. Violates that key range. So right here, this was the major level, right? It had previously bounced off of this a lot, and this is where the range was confined to. And then you gapped underneath, and the gap plus the candle violated that range, and you had a directional move in the favor of the gap. Again, for this to be an expansion zone, you need a directional move in the direction of the gap. What we would do is draw from body to body, not body to wick, but body to body of that candle, and in the future, this will be our future resistance level. And you can see we tagged it here, boom, boom. That is where liquidity will be in the future. And again, what you need, the requirements are a major level. It needs to be violated by a gap plus a candle. So the gap could have been into it, and then the candle violates it. So long as there's a gap plus the candle that violates a major level, that can be our expansion zone. In the example that the candle is like too big, for example, right here, you'll notice that there is a predefined range. You get a gap above it and a push. This is obviously an expansion zone. But instead of drawing from body to body, which makes the zone absolutely massive, we would just do it in the first hour. So the first hour of that is where you would draw your zone. You can see in the future, we did kind of touch that kind of first hour candle. Although you can't see it, it's probably right there. Here's an example of a non-expansion zone. So you can see that we did have a predefined kind of range, a major level. You gap down underneath of it. However, you did not see a directional move in the direction of the gap right after. Therefore, we would not draw a zone body to body because, well, how would that work, right? We gap down. You would expect to push to continue that. We would expect expansion in that direction. If we didn't get it, then therefore liquidity was not formed because off the open, people actually did not switch sides and they continued to buy the dip. So this would not be a zone we draw. The next zone is pressure levels. This is a unique one, but basically, price action is always setting an expectation in the market, whether it be most often the wicks can also often tell you that, but also just the general formation of candles. If you see 3 in a row that are, big bottoming wicks and they're closing green or maybe slightly red, but huge bottoming wicks, that's an expectation being set that the markets are bullish and that the next candle that forms is likely to be somewhat of a buying pressure or smaller selling candle. You would not expect all of a sudden a huge red candle to come in. And if it does, that means an expectation has changed. And when an expectation changes, that means there was a big dynamic change in the market, a mechanical change, and therefore we know liquidity was injected and caused this big move. So what we would do is narrow down on the time frame in that candle, where did specifically they inject that liquidity, because it's very specific. So if we look at an example of this, you can see right here, we had big buying pressure candles. The next expectation of these two right here was, hey, at least a small selling candle or another big one. Again, you didn't have earnings or anything. So the expectation was not to have this big red candle. When you do see this, this is obviously an expectation breaking candle. Therefore, it is a pressure level. And you'll notice that what we do is outline from body to body. This was on the 1 hour time frame. And then we go to the 30-minute and we say, okay, in that 1 hour candle that we outlined body to body, where was the most influential candle? Well, it's probably this one, because this one gapped down and violated majority of these big candles here. So we would narrow that line from here and narrow it down to just this one. So we've narrowed down this line, and it's realistically like right here now. And so we go down to a smaller time frame again. If you wanted to, you don't have to. But if you did, you'll notice that right here, as we came into the future, this was exactly where the zone was. It wasn't the entire candle, because the entire candle isn't where they injected liquidity. It's only a very specific instant that gave it momentum and follow through to then fall down here. So this is where liquidity was. But this is a pressure level, and that's, again, based off where an expectation was broken. This is an example of a non-pressure level, where you'll notice that when you do see 3 big candles in a row and you see these tiny little red ones, this did not break an expectation. A small selling pressure candle while yes, there were 3 big green in a row, is okay because the expectation is continued big buying pressure or smaller selling. It is not necessarily, hey, we expect a massive selling pressure level off of this. We don't expect that, especially since there's not a predetermined range. If you see, for example, a range like this, right? You see up, down, and then you see another touch down here and up again. The expectation is to sell off this level. So when you see this is not an expectation changing candle, even though there was just 3 little green ones here. Where the expectations change is when you see a dramatic change in structure like this right here. That is where you want to draw a zone. But you would not draw one here. The next zone is pretty simple. It is third deviations. This is a mathematical zone more than anything. All you want to spot is wherever there's a parallel channel in the market, preferably 4 to 5 touches that makes a parallel channel valid, you would go and you would draw a deviation. So what you would do is you would take one channel here and then you would copy it, and then this would be the second or third depending on if you're counting this as a deviation. 1, 2, 3. This middle line here would be your deviation level. So we say third deviation because we compartmentalize 1, 2, 3, this being the third, but you can call it whatever you want. The first deviation doesn't matter, but what you want to do is when you see that channel, 1, 2, 3, 4 to 5 touches, you want to copy that on top and bottom, and that will be your resistance zone. So, or liquidity expected to be where there's a liquidity zone. This being a deviation, that's where price is expected to be extended. And it's not so much a hard rule or concrete zone, but it's where you expect kind of a checkpoint of where the markets are likely to get extended, because once you move beyond a certain deviation level, markets tend to be mean reverting in that sense. The next zone is the less traditional one that I typically don't draw that much. It's called supply and demand. Now, you could call every zone supply and demand, but the idea is there's a more traditional way of drawing this, and that I don't actually use this method all that much. These are methods to drawing zones. In this one right here, all you're seeing is a high volume area with a wick on top. That's where you want to draw a zone from top of body to top of wick, or if it's a support zone, you would say bottom of wick to bottom of body. But so we get all through the material. This is just something I just don't do all that much. It's less accurate, and typically these other zones are more common. Now, with that being said, the next one, liquidity formations versus grab. This is super important because when it comes to when liquidity forms or when it doesn't, it implies 2 different things. So for example, when liquidity forms, you expect some sort of chop. Because whenever you see chop in the market, it means there's liquidity forming, because big positions take time to go into the market. Big firms, whether you think they know what they're doing or not, when they're trying to pass the torch and build positions, it takes time to do so. It takes multiple days at getting filled at VWAP or multiple days at some sort of price level for them to get all of what they want. And so when you see these chops, whether it be just in one firm or just a lot of retail traders, whatever it is, you know that liquidity is being formed, and especially when you see some sort of directional move. So you see a chop and a pump up, or you see a chop and a move down, the zone would actually sit right on top of this. And the reason for that is because, well, while they're buying here, it's called castle principle, that they would defend their positions up here. And a great example I can show you guys of this is this right here. So right here, we have a chop in the markets. This is where firms are building position. Now, this isn't to say they all know what they're doing. They don't necessarily know what they're doing, but this is what's happening. There's a passing of the torch. Maybe one firm is selling to another, et cetera, offloading shares, who knows? But what we know is there's a lot of position swapping here, and there's a lot of people getting in and out and building these bigger positions. And so while they are buying down here, yes, where they will defend their positions is right up here. And so what will happen is they're not going to defend down here. By the time you get down here, they're gone, they're going to liquidate, and they're selling. So what happens is you want to actually draw your zone on top of this chop. Sit right on top because you had an expansion. So chop, expansion up, zone sits right on top. If you had a chop and expansion down, the zone would sit right beneath it, right here. So right here, you have a big move up, zone sits on top. You can see they defended it before they got to where they actually were. This is what's known as castle principle. And the reason I have a castle here is because defenders, castles will defend themselves before the invaders get inside, arrows, you name it, because once invaders are inside the castle, it kind of defeats the whole purpose of a castle. So that's the kind of idea you want to do, but that is liquidity formations. Now, the next one is liquidity grabs. Liquidity grabs are when there's a void of liquidity. So not an excess of liquidity or excess of liquidity, but a void. And markets move off of 2 things. They move off of an abundance of liquidity on an area, but also a lack of liquidity on an area. That when there's a lack of liquidity, markets can move very rapidly. And the best explanation I have is this. Let's say you wanted to buy the famous RADER Report quarter zip. Okay. And if you guys see my Instagram or whatever, you know what that is. But the report, let's say you wanted to buy that quarter zip, worn by me, signed by me, whatever. There's only one in the world of that. The market for that is very small. There's not a lot of volume. So I can set that first price to $1 million starting bid. And so what that would look like on a chart is from 0 to 1 million in 1 second, right? So that was such low volume that it moved the price an extraordinary amount. Now, the more and more people that get involved in my market and start to bid, the more that price will actually condense and you will see it kind of trap itself to its true worth. So the lack of liquidity can move the market. And how liquidity grabs create a lack of liquidity is very simple. So picture it like this, that you have some sort of major zone, okay? And let's say this was the major zone right here. When you have a liquidity grab, what happens is you come down and you kind of have a V-shaped reversal. Okay, so this right here is a liquidity grab. This is not where liquidity forms. But when you come down here and you violate all these orders, now what happens is either everyone has gotten filled in the market or everyone is out of the market, and therefore there's no one really there. And so what happens is you see such a rapid expansion. And that's what a V-shaped reversal is, or a liquidity grab. Now, how that relates to us as traders and why that's considered a zone is whenever you see a liquidity grab, again, the parameters, I don't know if I said this, was that for a liquidity grab to be a liquidity grab, you need to violate a formation or a prior range. So right here, you have a very clear diagonal parallel range. You had a kind of move up, instant sell-off down. That's a V-shaped reversal. So what you want to do as a trader is kind of the upper 2/5 of this candle right here is going to be what we call a void of liquidity. It's a slingshot. And what happens is, when price comes up to that in the future, what you can actually count on is price to rapidly expand through that zone. So this is a zone that you actually want to bet against, that you actually want to anticipate on a market breaking if it does ever come up to that. So you want to count on at least 1 cent above or at least a new high, but never to be rejected necessarily exactly or underneath of that you want to actually anticipate a break. And you can see right here, the velocity of trend really increased when you had that kind of move through that liquidity zone because there was a void and they're going to take it to the next liquidity zone. So liquidity grabs are voids of liquidity and they move the markets and is the zone you want to bet on. Now, the last zone we're going to talk about today is shot gaps. Shot gaps are whenever you see some sort of gap and then you see, right before a gap, you saw a big expansion off of that. So right here, boom, you had an instant gap down. This right here is where liquidity is. Now, you'll also be wondering, hey, Raider, is this also an expansion zone? Yeah. This could be an expansion zone. This could also be, a pressure level. You could draw it the same with that. And you'll notice that probably if you narrow that down, it would probably come out to being a rejection here based off a pressure level technique. But you also would get liquidity up here right before the gap because this was an expectation that was really broken. Like all of a sudden you're going up, 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 and then boom, big gap down, not even into earnings, and you had this massive flush. So this was a shock. Therefore, people who have orders there, they're still there. They're sitting there. All the limit orders are still there, and they're going to provide a liquidity level in the future. Now, with that being said, those are all kind of the liquidity zones that I look for. Technical charts, they require you to spot different price action and know how to apply those zones to accurately kind of build where the best risk is and where we should be involved, etc. But now we're moving on to the liquidity laws. So actual laws of liquidity. What are the rules around liquidity zones? Well, the first one is watering hole principle. And again, this applies to all 6 zones no matter what. The more touches a zone has, the more likely it is that price action is to break through it. This law is, of course, called the watering hole principle because the more, animals that go to the watering hole, the faster it dries up and the more likely they are to go to the next one. And so what you can see here is that we had a liquidity zone here, 1 touch, 2 touch, 3 touch. You can see each time the reaction getting softer, the reaction back into it getting stronger. And you can see right here, you see, a move into it and boom, you move through it. So the more touches a zone has, the more likely it is on the next touch to break through. I see so many retail traders saying, you know what, I love trading trend lines with at least 5 touches. Well, that is literally decreasing your odds that zone will actually hold. And you wonder why it just flushes against you. Because each touch a zone has, the lower probability the next touch is to actually holding on that zone. So that's what you want to consider there. Now, the next zone law is gaps invalidate zones. And this is a liquidity law that is super important in the sense that whenever you see an after hours gap, again, this only happens once a day. You can't have multiple gaps throughout the day. It's just one on the daily time frame. Did it gap above or did it not? Prior day close to current day open. That's literally what gaps are. So prior day close to current day open, did it gap above a zone? And if it gap into or above that zone, it's more likely than not going to invalidate it, which means that it turns from a resistance zone to a support zone, but also most of the time just totally gets rid of it. When you do gap above that, it almost totally gets rid of it, and that people are just willing to, pick up their orders from sells and just pile into buys here, and that's what gives it that velocity. So it invalidates zones. These are zones that we would really no longer want to consider anymore based off of this gap here. We'd rather just draw our expansion zone here or pressure level, whatever you want to draw there. Now, the last two laws that I'm going to talk about is momentum. Momentum is incredibly important to a technical perspective, and going back to the mechanics of the market, whenever you're trying to develop a trade idea or you have a trade idea and you see a stock with a lot of momentum, that is something that could really sway your decision one way or the other, because it kind of determines how we trade it. And so what you want to understand is that momentum will validate zones or it will invalidate zones. For example, if you have a chart that looks like this, right? Really steep sell-off. Well, no matter what technical zone you draw, a support level, it's more than likely not going to have that significant of a bounce if the momentum down is super high, right? You're going to see a little bounce off your little support zone, but it's not going to be a big one. And what a lot of retail traders run into is they catch falling knives, and they try to keep catching falling knives. And they are good at drawing liquidity zones. And when they draw their support zone, they just have the wrong expectations of what bounce is expected to be off of that, right? That the momentum down is so strong that your little support zone really doesn't matter. And so what we want to consider is that momentum dictates, it validates the technicals. So, something with a lot of momentum here is something that you want to continue to play the trend on and not necessarily bet against until it slows down. Now, what you want to bet on the reversal or the dip buy trade is when momentum drastically slows down, when there is a kind of major slowdown in momentum. And we're going to get to plenty of examples of this when I review several weeks of reports on to show you how I actually implement these into my trading system. But this right here, this is something you want to bet on a reversal. Momentum has slowed. What does this mean? It means sellers are starting to get less active. There's less selling pressure, and therefore the odds of a reversal are fundamentally and mechanically increasing because you're getting that huge slowdown in selling pressure. Something that we don't want to bet on a reversal is this, when there's extreme volatility, no consistency, and something that is just sporadic. There's no meaningful action in there. But that's something that not many people of you can spot all the time. But this is something like a stock that just moves on its own. Penny stocks, things like that we typically just wouldn't look to for any technical guidance. What determines a likelihood of a stock continuing is also how strong did it close. For example, if you wanted to bet on a stock going higher, looking at something like this that's closing towards the highs, or something that is holding well above that kind of 50% fib level or something like that, is something that you really would prefer, right? We don't want to look at something necessarily that's like, oh, we're expecting a continuation trade and we see a close like this. This would be maybe a good reversal trade, right? Bearish, that's the least bearish out of all these. But when you see something like this is not something to bet on the reversal trade. And so when you look at something like the 50% fib line, which is that gold in the middle, this is something that you want to maybe consider in your trading. Again, I'm not going over everything and how I use it in my technical system, but this is a law in the sense that the close matters. How strong something closed or how weak it closed really does increase or decrease the likelihood of it continuing in the future. And the last segment of our technical perspective that you can actually go out and implement into your trading system is the expected ranges. What are these levels? Why are they important? Well, on every single chart derived from the options market, but also a mathematical standpoint, there are levels that within 70% of the time, there's going to be majority of the price action in between here. So some of the benefits finding the expected move is that it gives a roughly 70% chance of predicting the market's trading range within that day, week, whatever time frame you choose. And again, that's based off of this model right here, somewhat of a normal distribution. That one standard deviation out houses around 68% of total price action or the entire population. So in history, 68% of the time, the markets have remained within one standard deviation. And so why that's important is, of course, when you go and you find these levels in the options market, then you can actually chart these levels on your stock or whatever ticker you're looking at And that keeps your focus between where the odds are likely to be, right? We don't want to be charting levels that are way down here and trying to find game plans to get down there by a date when it's unlikely that by that date that's ever going to even happen. So we want to not only be focused with how we're timing things, this will help us time things, but also keep our focus to where we need to actually have it, which is within kind of the proper side of the odds, right? That 70% of price action is going to be in between here, so I'm not going to waste my time trying to chart out levels way down here because I don't need to. Over time, through repetition and charting these different liquidity zones I showed you, including the expected range, you will get very good at developing a charting system. Charting for me is second nature. I can do it in my sleep. I know what zones are important. I know which zones aren't. And that comes through repetition of thousands of charts. I mean, I could just keep posting them on screen right now, but I've created thousands and thousands of charts over the years, and I know my system. Technicals are pretty straightforward. If you know the zones and you know the laws around them, then applying them to the chart should be pretty damn straightforward, especially since we've already established that we're not just going to be trying to find pure trade ideas from them. We already have a trade idea. We're needing to implement it into a chart, and that is where technicals become useful to us. Now, to assist in your studies of these technical concepts, I'm going to put a list of quote-unquote buzzwords on screen now. These are a list of words I've created so that you can kind of Google these and Google different questions around them, Google different phrases with them, and expand your web. Of course, when you Google one, you're going to be led down a path, multiple different directions. That's how you learn. That's how you're going to find stuff you're unfamiliar with and run into concepts that you might find extremely helpful to your trading. Believe me, this is exactly how I learned, and I'm going to include one of these lists at the end of each of these segments. Now, the next part of market mechanics is seasonals, and seasonals are incredibly important in improving our timing as traders. Many of you think that direction is the problem, but it's reality. It's extremely easy. We know what bullishness is. We know what bearishness is. We know what that looks like in the markets, but how about when that comes in? When is that bearishness going to come in? When is that bullish trade going to come about? That is the million-dollar question. The best traders in history have all had great timing. Seasonals help extremely with better our timing in the markets when we place trades, when we get out, and building expectations around that. Seasonals are also a leading indicator or a leading concept that actually front run the market, so we can gain value in that and be prepared ahead of this seasonal period that we're coming into. So the second component of market mechanics is this idea of seasonals, and that during certain times of the year there are certain kind of tendencies of the market. Why is it that normally every March and October that the markets tend to bottom? Why is that? Why is it those specific months they tend to always almost create some sort of bottom in the market? Whether the duration of that bottom depends, but why is it that is when you can expect a lot of these positive flows? Likewise with February, why is it that early February or into that late February period you typically get a lot of weakness? Even with more recent times, you come into this early later February period, you're starting to get a lot of weakness. What creates this? Is it magic? Is it pure, psychological reasons? No, there are mechanical reasons that cause this. For example, into the end of the year, you get a lot of positive flows because the biggest OPEX or options expiration date for major indices is in December. And that with this huge rebalancing, especially after the September 20th quad witching, which is where futures options all expire on the same day, you typically get this massive inflow of positive money moving into the markets. So there are mechanical reasons. And while I'm not going to sit here and explain each one, what you can understand is that seasonals allow you to front run the market because there's behavioral or tendencies during certain times of the year. For example, as we approach the more recent February period, you expect some sort of run up into mid-February, but ultimately into OPEX, into this expiration, you can expect significant weakness through early and mid-March, where eventually, if it does sell off or how bad it sells off, we can expect a bigger reversal into late March. But these expectations we can prepare for. We can say, hey, you know what? Now that we have kind of this expectation building, how do we make a game plan around that? Well, there's different ways. And again, I go over all of this on the RADER report in depth. I have a complete seasonal report as well that I release with timelines, explanations for February. So if you're watching in February, these are the expectations. And what you'll notice is, the monthly seasonals, even the daily probability close, that Monday had an 81% chance to close green based off history. And well, you can see from open to close of Monday that we closed green. Is that a coincidence? No, it's just being on the right side of the odds. And by us seeing these expectations, we can say, hey, you know what? There's strength off the open. There's a high put to call ratio. 81% of the time we close green, I'm betting long this day. And so these really help with not only your timing, but also in how you position for the future in your direction. Seasonals are pretty straightforward and basic, and we don't need to spend too much time on them because there's extensive resources within the RADER report itself, but also the tools on there to analyzing the different ideas with seasonals. There's charts and things like that you can look at to see where are the worst and best trends that you can expect throughout the year. But it's a pretty basic concept that during certain parts of the calendar year, March, April, May, June, that you can expect certain price action tendencies. And based off of that kind of expectation, how should we be trading? What could we, trade to best benefit from this expectation? So seasonals are extremely beneficial in not only knowing when, but helping you point the direction of to what. What can we long during this time period, and when can we take advantage of this, and for how long? And again, seasonals are a mechanic of the market. It's not just an observation of, oh, well, it tends to bottom in March, but there's no reasoning why, just an observation. No, there is a reason why, and that things like March, October, they have underlying reasons behind them relating to the flows of when money is expiring relative to quad witching and things like that, and when you can expect positive flows. Money managers to take that money that it did expire and push it back into the market. Because remember, guys, firms are funded by clients. Clients want their money in the market. So 90% of the money in the market is from bigger firms having clients saying, put my money in the market. And so there's going to be positive flows over time. And that's why markets tend to always go up, is because with the growing markets and the growing demand for U.S. equities, you also have, of course, people willing to continue to pay premiums for a growing economy and good companies. And let me be clear, this is very different from things like pattern trading, which is just an observation of what price action tends to do. But there's no written rule or underlying reason why a head and shoulders or a crab harmonic pattern works the way it does. It's just an observation. It's just here's what tends to happen, but it's not necessarily a rule. It just tends to happen like that. These things I'm showing you have fundamental rules and reasonings behind them relative and related to the processes of the market. And on screen now is the list of buzzwords related to seasonals that you can go and branch out your research with. Now, the next segment of market mechanics, which we're going to spend a little bit more time than seasonals on, is rotations. While they work hand in hand, rotations are an incredibly important concept to understanding, number one, what to play, but also when to play it. There's a concept in the market known as rotations, and what it means is where money is moving around in the markets, when it moves, but also where, right? That during certain times of the year, you also have rotations more into growth or less into growth based off what it is, but also this idea that, well, wait a second, if growth themes are starting to weaken, where is this money going, right? That firms are selling this position, but remember what I said, that 99% of firms are funded by clients and they want their money in the market. So they're taking money out of one thing, but that doesn't mean they just hold it in cash. They have to put it back into something else. And so seeing that rotation from risky growth assets into something like defensives or bonds, something like that, that is important. And there's ways that we can actually analyze this as day traders on a smaller level, a micro level, but also a macro level that we can benefit from. And we as traders can see rotations through a variety of different tools and understanding of concepts. This tool right here is known as the RRG charts, and it's one of the more popular ones that I do use, especially to visualize rotations better. This tool right here basically takes price action and it does a few calculations, and instead of showing it through the lens of candles, it shows it through the lens of momentum. So this isn't really anything new, but it's just a different form of price action that we're seeing through momentum, a reading of momentum. And what this chart shows is 4 different quadrants. And again, I'm not going to go super in depth of how to read these or the different things you can look out for, as I do have another video on my channel for this. But we use this tool all the time to spot things like what rotations are going on right now. Is there, on a broad market perspective, is there a growth rotation? Or in the instance of this right here, is there a defensive rotation? Are firms pulling money out of growth and piling it back into defensives? And if so, that is a leading sign that the markets, well, will drop. And you can see right here, just shortly after this defensive rotation, markets began to drop, and drop significantly they did. Was this a coincidence? No, it's a mechanical process that is in preparation for more weakness in the future. Firms do this and are partly the cause of these drops because of this rotation happening. And again, it's the concept that you pull money out of one thing, it's client money, they want their money in the market, and so the firms have to put it into something else. And this makes a positive flow into one thing and a negative flow out of the other almost all the time in the markets. Now, during certain periods of the market, those kind of rotations will be dampened or magnified given the condition of the market. Whether it's a bull market, of course, a growth rotation will be more severe versus a bear market where you see a growth rotation in this. It's not going to be as pretty, or it's not going to see as big of a rotation as you would see in this growth rotation here. And not only can we look at RRG charts to get an idea of what we do in the future, but we can also use a broader concept in understanding that, well, what happens when a market sells off? What do we bottom first? And other than the RRG charts, which help us visualize these rotations, we can also have a broader understanding of rotations in the market that, especially in market bottoms, the most beaten down names. When you have, let's say, a market bottom, the markets are crashing, and here's two examples here. In the market crash off the bottom, who do you want to buy? Well, you want to buy the most beaten down names. So not these names, but you want to buy the most beaten down names first, because those are going to get the most aggressive reaction. However, once those start to fade off, they have the shortest lived reaction, and these start to struggle, and maybe they start to climb higher. The previous trend leaders, which did not drop as much, given by the slower drop here, these will have the longer continuation trade during that same period of time. And so understanding rotations that, okay, if a market's about to bottom, maybe let's say during a March period, right, that we know seasonally speaking, markets tend to bottom during March, then we can go, okay, what's the most beaten down names? Well, it's going to be, let's say, software, oil, all these other guys. Those are going to be our first trade. And once those get those big rotations we look for, then we don't want to hold those long because that doesn't last long. Then we can kick back into, the longer continuation trade, which is going to be the leaders, the stocks that did not drop as much. And we can see this in example for something like COVID. If we go back in time to the COVID crash, I'll show you a perfect example of this. During the COVID crash, the markets here dropped around, let's say 30%, I believe it was, but we'll just measure this out right now. So markets from top to bottom dropped around 36%. Well, what names do we want to buy? Well, the names that got hit the hardest were airlines. Well, obviously because no one was flying during COVID. So if you go and look at these guys right here, airlines dropped almost 80%. So this was the most beaten down name. And so when we expected a bottom in the market, we wanted to go buy what? Well, we go buy the most beaten down names. And so it might not look like it on the chart, but UAL off the bottom nearly went 176%. So 200%, initially over 100%. The markets, I can tell you, certainly did not go 100% up. And you can see right here from the drop here, during that same period of time where UAL bounced, the markets only went up 18%. So buying the most beaten down names first gave us that massive rally, that big move initially, but then that was the shorter lasting trend. We don't want to hold that. And then it's the trend leaders, the ones that did not drop as much, that we want to buy for the longer period of time. This understanding of rotations is huge. And there's so many more concepts I could talk about today, but we will talk more about that through our demonstration of the RADER Report trades and how we implement this all together. And again, I want to keep going back to this point that the stuff I'm showing you right now that you should probably be infusing into your trading strategy is known as a mechanic. It is almost like a rule, almost like a fact. And you always hear people say this, that technical analysis is kind of like that ice cream and crime stat, right? That a decrease in ice cream usage means an increase in crime. Just because two things are kind of observed to be moving together doesn't mean they're necessarily correlated or that they're causation, right? That you can say, oh, well, 90% of the time ice cream goes up, that crime also goes down. But that's not what this is here. And you can say that, though, for technical analysis. And why a lot of retail traders fail, like we said, was because they rely on technical analysis and they don't realize that price action and the overall or underlying movements of the market aren't necessarily always correlated, in that you need another reason to justify why that price action would move for it to actually have a correlation. And so what we're showing you here is that these are true correlations. This is an increase of police officers on the street mean decrease in crime. This is, we're observing the same changes in values. It's an actual relationship, a mechanic, something underneath of the hood of the markets that actually is moving it. On screen now is the list of buzzwords related to rotations that I think you guys should look up and do your deep dive research into. The last and most important concept of this market mechanics perspective that I have built out that I want to share with you today is the options market, and specifically its relationship with the underlying or shares market. Now, many of you, if you've been following me, you know all too well what this is. But in today's world, I'm not even joking, I think less than 5,000 people on the entire planet Earth understand and have truly mastered this concept. In today's world, the underlying or the shares market, the equity market is what it's called, is being controlled by the options market. Now, why is this? Why would I want to build a strategy around this? And why did you, Raider? Why were you taught a strategy around this correlation? Well, it's very simple. Over the last 10, 20, 30 years, there has been a huge revolution into U.S. equities, firms, money, all this money pouring around the world into U.S. equities. The United States has become the staple for the world economy. And with so much money pouring into U.S. securities and markets, you have this massive demand that's growing for hedging, and that people, money managers, everyone wants to go and hedge their risk. And they do so by buying or selling options. Majority of people are going out to buy options, but what people forget is that there's another end to that trade, and that there is influence that is created from the options activity. When you go out, let's say you're a big money manager and you want to go hedge billions of dollars worth of positions, you're going to go buy a bunch of puts. And when you buy puts, you get to own puts. But the other end of that trade is a market maker selling the puts contracts to you. And he theoretically can take an infinite loss because you can take an infinite gain theoretically. If the stock goes to zero, you're going to be up hundreds of thousands, if not millions of %. So in order to hedge this risk, the market maker, he doesn't just go out and buy more options or something like that. He has to hedge his risk by buying or selling equity according to whatever that was. So for example, if you went and bought billions of dollars worth of puts, the market maker is going to go out and sell billions of dollars worth of shares. He's going to be short. However, with the passage of time, options do expire, and over time they lose value, right? These puts that you bought, they're going to be losing value as they near expiration because you paid a time value premium, and you also paid, let's say, an implied volatility premium that, oh, well, we're expecting this move, so I wanted to hedge this amount of risk, right? And so both of those are going to be extracted as you get closer to that expiration date. All options expire, they're going to lose a lot of value. And so when the puts lose a lot of value, well, guess what? The market maker hedged all of that stuff. He doesn't need all those hedges anymore. So what does he do? He starts buying back equity that he shorted, and this creates buying pressure, and that's why stonks go up. That's historically why they have always been trending up, and they're always being passively supported because market makers continue to buy back stock over the passage of time. And by understanding this massive market-wide correlation, what you can actually do is take that understanding of how options influence the broader market, and we can actually narrow down that focus into individual tickers. And that's kind of what we specialize in, is that, hey, there's, a bunch of flows that go into the overall market, and we can analyze the impacts of those. But there's also individual stocks, that individual stocks are their own little markets with their own options, with their own shares being offered to them, and that certain orders that do come down onto them can influence those individual tickers with the extremely high probable and edge-filled trade. Now, again, this is not a complete walkthrough of each individual concept. These could be hours on end for each one. However, this right here, I'll just show you some broad market impacts that we can observe with the options market on directly the underlying being the equity markets. So even right here, a few weeks ago, right here, I put in the report that there was this massive kind of put wall heading into 131. So January 31st of this year, massive, absolutely massive put wall. And of course, a lot of puts that we talked about just earlier, a lot of puts can make a market maker go short, and if you start to slow down around there, you can expect a lot of buying pressure, because as those puts lose value at the money strikes, which have the highest theta decay, then the market maker is going to be forced to reduce his hedging, aka buy back shares. So this right here, we kind of was like, hey, this is 150,000 open interest on 590 and just below it as well. If the markets come down to here, this is a weekly expiration. It's actually more open interest than the monthly expiration, which you would not expect on something like SPY. This is a massive wall. And so we said, you know what? If we come back down here, it's likely that this is the bottom. In the worst case scenario, if we ever touch 590, this is going to be the weekly bottom. There is no way, mechanically speaking, that markets let the markets close underneath of that unless if some tremendously horrible news comes out, which is just not likely. And then we'd likely close probably above 600, given that this is how many puts we have stacked on there. Well, if you actually go look into the week of the 31st, you can see, well, wait a minute, right here, this is the 31st. Coming into the week of the 31st, we gapped down on Monday. Instantly, we went to 594 during the normal hours. But if you actually go to the after hours, you can see what level did we bounce off of? Well, we bounced off of 590. The 590 put wall was the massive kind of driver of this bullish move right here. Is that what happened was, well, we tagged it in the after hours. Market makers started to buy up shares into the pre-market, and well, you never looked back. You just kept buying up all week. This was a mechanical response because what happened was the puts went at the money. They gained a ton of value, and then all of a sudden that premium was crushed as soon as the implied volatility was starting to get smacked here. The VIX dropping, everything got crushed, market makers forced to buy back shares. And it wasn't until we got closer to expiration that, well, wait a minute, these puts lost so much value. I have all these shares, I don't need them anymore. So he starts to offload them. And then all of a sudden, boom, another news announcement comes out. So Rader, you don't have puts, you didn't have a put wall here because remember they expired on the 31st. So what made him buy up this time? What happened? Why did the markets buy up off of 590 again? Well, it's a similar story, just a different perspective. Check this out. On that day, what happened was we can use something like a PC ratio, a put to call ratio. This is another broad market kind of perspective we can use in analyzing the relationship between options and the equity markets. At open on February 3rd, the put to call ratio had a massive spike up here all the way above 0.8. This is a highly elevated level. And so what this means is right off the open, people were buying puts. They were spamming puts. They were rushing to go hedge. And when a market comes in and starts spamming a bunch of puts, it's the same story that repeated last time. That, well, instead of the wall already being there, they're building it in real time. And that's what drove another mechanical response in saying, all right, we're going to start buying up shares because market makers are just going to keep forcing it against those puts as they continue to lose value. This broad market principle right here is incredibly important. Put call ratios, even put or call walls, which again, I have another video on as well, are some of the most important concepts in understanding where and when a market will reverse. Because we have a level, which was 590, but we also have a by when. If it's touched by 131 of January, we can expect a major reversal off of that on any kind of slowdown there, because that's exactly when we expect market makers to start buying shares up, because they have a priority, they have an obligation, they have a legal duty to do these things into this expiration. And so what my mentors did was they said, okay, you know what? We can take this understanding of broad market concepts of how, put and call walls and the amount of puts and calls and the relationship it has with the underlying, how it affects, the bigger, broader market. We can actually take this into an individual perspective and say, hey, you know what? If we look at individual orders that come in, well, we can actually pick out certain tickers that meet certain criteria, certain orders that fall under a criteria that will likely have an impact on the underlying. And if you didn't watch my previous flow video, literally the video right before this one, you absolutely should. But while the secret sauce to spotting kind of flow trades is somewhat of an industry Rader trader secret, you can go watch that video. What we really look for was, hey, let's consider all the factors of what goes into an order, such as the premium spend. Well, we don't want it to be too big because then it's likely to have a target on its back. It's likely to just be kind of suppressed or stalled out, right? That if an order is way too big, well, it doesn't necessarily mean it's going to have a reaction against it because it's so large, it's likely to cause nothing in the market. So an absolute huge nothing burger. But likewise, if we're trying to follow an order, we don't want to necessarily follow an order that's too small, or if we're trying to bet against one, because if it's too small, it's not likely to create an impact on that underlying stock. Also, we consider the ticker. Hey, you know what? The ticker is important because the $1 million order on Tesla is not the same as $1 million order on XLU or $1 million order on Caterpillar, like we said. Those have different implications and different impacts because market caps, how often they're traded by the overall markets. Tesla is one of the most traded derivatives in the world, where hundreds of millions of dollars of orders come in each day, so if not billions. So it's not really impactful when you see a couple $100,000 thrown on it versus something like snow. It would be very impactful if you do see $1 million order come in. We also consider what order type it is. That's a really big impact as to kind of determining how aggressive is it. What are they trying to do? Things like that. Also, the strike price. It matters a lot, right? If we're observing orders, strike price matters a lot because for things like Nancy Pelosi's trade, a lot of people get worked up. She bought 500 strikes in the money on her NVIDIA trade. That is not something we want to follow. That's not something we care about. Number one, we don't care about Nancy Pelosi's trades. But when we're looking at orders, we don't care about orders that are outside of expectations. Option flow, 500 strikes in the money is not going to have a market maker balancing that much off of it because, well, it's 500 strikes in the money. What is he going to try to, make it go out of the money, drop the stock 500, points because they got that order? No, that's not going to happen. That's way too unrealistic. And then we also consider expiration dates. This is really important because when we're trying to find edge in the markets, we need to see an order that can be taken action upon soon, right? An order that expires in 1 year, we don't know when that's necessarily going to cause a reaction from the market maker. However, if we have an aggressive, large size order that's fresh, that just comes in and expires in 1 week, then we have a very nice window of when we can actually expect something to play out, because those 7 days, the market maker has the same 7 days we do to balancing and causing that reaction. So that's where we care about expiration dates, the sooner being the better. And we take this understanding and we use a platform such as Black Box Stocks. This is my favorite because they by far have the best filters. Other services have decent filters, but this by far has the best and makes it the most time efficient, once again, that I've found. And when we go through that process, we can find trades like this one that we showed on the journal earlier, BAX, that, hey, this huge order came in. It's only 695K or 700K, we'll call it, which isn't that much for a stock like SPY, but for a ticker like BAX, that's a ton, especially considering this guy only put 1 week on it, and he even added to the trade. So the market maker bounced one, and then another one came in, and it's like, oh shit, now we really got to do something about this. So he doubled down. This was a hedge order. It met all the criteria for hedge order. Not only that though, right? That we have to put this into context. It was during a positive seasonal period that going forward for BAX, you typically see a major run up into February. And that's exactly what we're betting on, that this guy placed this massive hedge flow here right in time for the seasonal. And so we typically, even though this is a put, we would bet against it because it is a hedge flow. It also fit the book that healthcare names were on the agenda. They were the stronger stocks. They were the names that were moving. J&J, these guys had really great setups. Healthcare as a whole was outperforming, and BAX had a great seasonal period coming up with that hedge flow order. And if you look at the seasonals, again, the reason I went so into depth about the technicals earlier on in this video was that when we consider momentum, when we consider these different things, this all plays into our system. And we're going to review trades after, this, but you can see that after this huge period of selling, we really had this slowdown. We had this kind of curling around of the trend. And then all of a sudden, this guy placed an order on the 8th, and then he placed an order on the 10th. And then what do you know? Instantly after him placing this order, we had a massive rocket ship. And this is what drove that move into expiration was, these two orders. They helped drive the markets into 117. And you can see on 117, what happened was, well, you had this massive kind of post-expiration move as well, which we were betting on. But you had this kind of sell-off after as market makers start to offload shares following that huge momentum. So really one of the greatest mechanics you can understand is how the options market moves the underlying or the shares market. You saw here different broad-based kind of techniques that we use. There's a ton of them, but I showed you specifically the put to call ratio and how, well, in the morning that spiked tremendously. And that kind of means that, hey, you know what? Everyone's buying puts. You have some momentum against the downside, and what do you know? Market makers are going to keep buying back shares, drive the market against those puts. And also, I showed you kind of what it was like to see, put and call walls. Specifically, we tagged that 590 and we bounced off of that, seeing that abnormal amount of open interest, forcing the market maker's hand to, again, rebalance and buy back shares. I also showed you that we can take that broader concept of the overall flows in the market on a broad scale and narrow it down into individual tickers and say, hey, look, there are certain orders that appear on certain individual tickers, and there's certain impacts that we can expect from those. So putting that all together, and even with all the other stuff, you can see how this mechanics, if you're building a strategy, you want to include the mechanics of the market, because these aren't just observations. These are written, hard, cold facts about the market. We know what market makers are going to do. Not only are they all educated the same, but they also have the same legality, the same legal ties to the market and what they have to do and how to balance their books. And they all have the same legal kind of interest that firms in the market all want to hedge. They all want to remain balanced, and that this kind of concept will never go away. So you want to be able to learn this stuff so that you can stay here and adapt with changing markets, but really use concepts that don't change all that much. And so that's really what the market mechanics is getting at, and why I wanted to explain all of these kind of in more detail, not as specific as I could get, but just a broad overview of each concept before we move into how to actually build this now into a funnel. How do we build these different concepts into a funnel? This on your screen right now is what I call a funnel. And what it does is it helps us narrow down opportunity in the market to what's relevant, to what's likely to move, to what actually has edge. What is a huge major problem for a lot of traders in today's world is they're trading things that, yes, do go up when the market goes up, but there's things that go up more when the market does go up, and there's things that go down more when the market goes down. So while you're stuck trading these inopportunistic kind of opportunities, you're trading things that just move, but they don't move that much, and so therefore your gains are always average and your losers are always bigger. That's not a great way to trade. And so what we want to do is find stocks that actually move, find stocks that have edge, find opportunities that are relevant. And so by creating a funnel, what we're doing is we're narrowing down not only the tickers, but the opportunities we see. And this is kind of the order of my funnel. I'll show you some different variations of this you probably could do. But what I always start with, the kind of broader mouth of this funnel, is always going to be market context. And again, at the end of this video, we're going to go through different examples through the RADER report, putting everything together. But right here, the market context, what do I mean by this? Well, this is things like, understanding news, or what is the market thinking? I always, when someone asks me, hey, what do you mean by market context? I always say, ask yourself, what is the market thinking about? And so just recently, you could probably say tariffs. Just recently, you could probably say the election. We were in an election year, and that creates a huge theme to trade alongside, right? Industrials, energy, banks, of course, being that Trump won the election following November 5th. What was the reaction of those? Those got the biggest run up into the inauguration day. That, hey, on day one, he's expected to probably release a lot of deregulation on these industries, and so that's probably going to cause a major pop there. But that right here, the market context, is what we typically use as the broader mouth. And so what that does is, okay, Raider, let's say you found industrials, you found energy, you found banks, and maybe you found healthcare as well, because when Trump won, there was a big sell-off in healthcare, but maybe the markets were a little too harsh on them. So right here, we have just this kind of theme. We have just a broad, big list of tickers, but we've already narrowed down like 1,000+ tickers in the market, right? We're not looking at Krispy Kreme donuts. We're not looking at, certain penny stocks. We don't care about those. Those aren't really relevant to Trump right now, or they're not relevant to what the overall markets are worried about. And so now that we kind of have this kind of list, what we can do is then go on to the next one. Well, of that list, of the tickers that the market are thinking about right now, the general theme, what is kind of beneficial to that theme? Is there a rotation going on? Is there a seasonal period? Well, wait a minute. Coming out into mid-February, the first few weeks of February, first 2 weeks, you expect some bullish price action. Okay, so maybe industrials and energy, those would be good because those, again, are related to the theme. But also, maybe let's just say not banks. We don't really care about banks. Okay, so you narrowed down banks. They don't really have a great seasonal, whatever. That's fine. So we've narrowed down a ticker going on to the next stage, and a rotation as well, right? Is there any that has a stronger rotation? Maybe energy is outperforming industrials, et cetera, et cetera. So now we're narrowing down tickers. We're going through and we're narrowing down the edge. And so then the next thing, what I typically do, and you'll see there's kind of this little circle here. These are interchangeable. But then I look at the options market and kind of the technicals. Once I kind of have this idea of what the market's thinking about, what are the seasonals and kind of the rotations, what's favoring what, then we can go look at the options market and say, hey, is there an imbalance in this name? Is there a specific option flow we can observe? Is there, in the case of healthcare, like BAX we just reviewed, is there a hedge order? Like, heck, that fits the narrative of bullish healthcare because they've been kind of beaten down, maybe over beaten down since Trump's election, and that he's not actually going to do that much about healthcare as far as restricting policy. That's why they sold off, because typically Democrats favor healthcare over the harsher Republican red party. So that's when you go in and you look at the options market and technicals. Now, you're not always going to get an options market read on a stock. But notice how technicals is last. I cannot stress this enough, that the only reason, let's say we get through all of this list here and we do all of this screening, and the only one I like is some sort of holding in XLV. Now, you notice I'm doing overall sectors. That doesn't necessarily mean you have to as well. But right here, let's say we only come out with healthcare, energy or whatever, it wasn't that good. When you get to a chart and you're charting things within healthcare, now what you've done is you've created kind of this resume for those technicals. So you created a resume for a chart. And what I mean by that is, now when you go and you look at a setup like this, and the setups are the same, now you actually know, yes, I know, even though these two setups look the same, I know the stock is going to move and likely to move because it has a good resume. right? It has all these factors leading into it that match. It has kind of that preface, that setup, that into the price action behind those candles that makes sense. Now, there are different variations you can do to this funnel, and I encourage every trader to experiment with the concepts if you're still learning or you're more matured in your kind of trading, that you can interchange a bunch of things. Like, for example, if you don't do necessarily charting or technicals, maybe you have some sort of quantitative, right? Maybe a quant signal. Let's say you have some sort of quantitative model that, hey, based off these conditions, you have a stock that extends 0.4 deviations out, and you have kind of this X momentum on it, but also it's in this sector. That's a signal that can be validated from everything beforehand and actually improve the accuracy of it. That a lot of trading, the best traders in the world are three-dimensional in thinking. And what that means is that they're not just copy and paste. They see a MACD crossover and they enter. That's not what it is. And maybe you do have some sort of indicator, for example, that you like using. Only after all of these conditions are met is that indicator really going to be useful to you. So maybe, a lot of people say, oh, well, MACD doesn't work, RSI doesn't work. Well, it doesn't work because you're not going through these filters. And, as somewhat of an indicator hater myself, I can tell you that that's not true. Indicators do work, but you have to go through this funnel process first to find the opportunities where it actually makes sense. So you can interchange those. You can also maybe say, instead of rotations and seasonals, that you're, maybe just doing some sort of news, or that you're looking for some sort of catalyst, because that would be, following, market context that, Trump's into big IPOs. We have a lot of IPOs coming up, a lot of mergers probably. And so the next thing I want to look for is news instead of rotations and seasonals. And then once I see some sort of news come out, I want to only trade the ones, that have the, best setup, the best technical setup, or maybe the best options and balance or something like that. So there are interchangeable factors to this, but I encourage everyone, if you're going to succeed in trading, you need a funnel. And my kind of request is that you put technicals towards the end, because that is really going to be the last thing that validates your trade idea. Because all great investors, the guys who beat the stock market, they all had an idea of what the markets were doing, where they were going before even pulling up a chart. They had an idea that said, hey, look, I believe in this company. Even Warren Buffett, I believe in this company because X this, X that. He has great leadership, and that has nothing to do with the price action chart. So there's different styles of investing, but what I can tell you is the best investors, from the longest term, like Warren Buffett, to the shortest term, they really look at all the factors before the technicals in making their decisions. So now that we've built out the different market mechanics and how you should be weaving these into your trading systems, including eventually creating a funnel, now that we're stepping up to the plate and we're ready to swing, how do we actually go and execute upon these ideas? Because having a great idea is one thing, but going and actually implementing and trading that idea is another. And so what we're going to move into now is execution. The third and final part of building a strategy is execution. And what we're going to talk about are three major things. We're going to talk about entries, exits, and most importantly, position sizing. So on screen now, what I've done is actually built you kind of a little model that is almost to the T how I exactly trade according to different categorizations of setups. Earlier in the video, we talked about it's important to have, some sort of categorization of your setups as you mature as a trader from A, B, and C. You'll be doing this when you journal. But right here, I have different rule sets for different kind of styles of trades. And as you become more experienced and you start to see where your edge really develops, then you'll be able to categorize these better. But right here, A, B, and C setups. A's are typically a lot of the option flow trades I have. B are maybe something related to the option market, but necessarily not flow, but still relies heavily on some sort of principle within that and some technicals. And then C are often what I call pure gambles, something that is taking advantage of more so a kind of skeptical play, something like the Carvana play that we had not too long ago in the RADER Report, betting that the kind of research of Hindenburg would blow up. And matter of fact, it did, netting almost a 2,000% return for us. But that is more highly speculative and something that I would definitely consider what my position size is going to be, and certainly was during that time. So starting back from here, the C setup, again, each one of these covers the max position size, the entries, and the exits. What I typically do is I have a benchmark of a position size. So what is your normal position size? And often what your normal position size is going to be what you're willing to risk on each trade. Now, this will vary across accounts, but I can tell you that around most of my positions would sit around $1,000 each for these shorter term swings. So when we say max position size, no more than 2/3 of that, I'm no more willing to risk, kind of $600 on that, or 666, whatever, but let's just call it $600. $600 I'm willing to risk on a lot of these trades. Underneath of that is entries. Now, how is this different from max position size? Well, when you first go to swing at that trade, right, we have to understand that this is a highly speculative trade and that we don't know, and that in theory, the best way to take advantage of this opportunity is to get in with less and then add into it as we are proving correct. A lot of you guys like to add in big before you're proving correct, and then as soon as it goes wrong, you get smoked. But if you would have just waited until you saw something prove you correct, then that is. It could be a gap up in your favor. It could be that sudden surge of momentum, something like that. Well, as far as this, I would only be willing to enter right off the bat. My first entry is going to be 1/3 of my normal position size, so around $300 at the golden pivot level. Now, you guys are probably wondering, what does he mean by pivot? Each trade that I outlined, especially on the RADER report, I have a pivot level. This is where it's going to likely cause a major reaction. And in this case, the UAL trade that netted us around 150 to 200% here, this was the pivot level down here at 101. There was a max pain level we saw based off the options market, and this was the max pain point that I was willing to enter at. Now, this was not a C setup, but that is what I'm talking about. The golden pivot. At a pivot level, I'm willing to enter with 1/3 of my position size. Now, your exits. Your exits can be targets number 1 and 2 or based off of momentum. And so what you can say is, okay, well, I can start to exit some of these contracts coming into target number 1 or target number 2, or make it based off of momentum. Let's say one day you wake up and there's a huge gap up over your first and second target. Well, all of a sudden, you don't necessarily have to take out because it just hit the second target. Let it run. Let's see where the momentum goes, because you're up so much, you might as well hold and see where this goes. So momentum is a big player in your kind of exit. But also what I want to add here is you'll see that my max position size is 2/3. I enter with 1/3. So RADER, where's that other 1/3 going? Sometimes, again, based off momentum, you can add into target 1. Now, you might be asking, RADER, what is target 1? How do we draw targets? It's just going to be liquidity zones. So when you go and you draw kind of a target here, if my entry was going to be here, what I had said at the beginning of the week is that my first target would be this gap fill here. That if we were to enter down here and get an entry, our first target would be gap fill. So this was actually our first target, and I actually added into that target rather than actually taking out. So this is a good example, but again, this was a different categorization. This was an A setup. But as far as C, this is what you want to think about. So these are more speculative plays. These are trades like that Carvana we had a while ago, where we were betting on Hindenburg Research getting nuked, and they did. That was down here. Right here, we had this level that gapped up into where Hindenburg Research shorted at this 200 level. And you can see they just instantly started short covering. They announced that they were going bankrupt, basically, and they were packing up shop. So that's what really caused this massive surge. And of course, we capitalized off of that, but I only added around 2/3 of my position size, netting around 1,600%. But that was it. And again, I added at target 1, which I think at the time was around 212. We can look at that previous report. But as far as the next setups, B setups. Okay, so now the max position size for this is normal position size. So this is kind of the benchmark, right? What I'm willing to risk on a trade kind of normally, right? The normal position size, I know that sounds weird, but you're going to have to find that normal. What makes you comfortable? What is comfortable according to your account that makes sense? That's not too big, that lets you have a numerous amount of tries in the market, if you will, assuming you lose 100% on each. But next, we look at entries. So right here, there's 2 possible things we can do, 1/3 and 2/3 on our initial entry. And so when you get, again, at a pivot, you can see for B setups, again, these are typically setups for me that don't have necessarily an option flow, but still have some sort of kind of options imbalance on them, or something like a put wall, something like that. Not purely technical, but something that really does fit the narrative, but I'm still, again, not sure of. I need to see if this is going to be proven correct majorly on my timing, right? That's why we only enter with around 1/3. So you can enter 1/3 or 2/3, never to your normal position size. The only way that I kind of take normal position sizes on Bs is that it has a lot of momentum and it goes into number 1 and number 2 with a lot of momentum. So again, it comes up into target number 1 and number 2. Think of targets like checkpoints rather than necessarily hard stops. These are checkpoints to evaluate, is the momentum slowing? If so, maybe I take out, or maybe I add as it starts to pick back up into that level. So again, based off momentum, if it goes absolutely crazy, then you hold it till it slows down. There's few exceptions, such as this Carvana one. This went absolutely crazy. You hold it till it slows down. This is when you want to start taking profit, not here. This is when it gets absolutely crazy and you want to hold. But right here, this is what you can do on your initial entry. As far as your exits, again, same thing. Number 1 and number 2 are possible exits, but it's, again, based off of momentum. And at the bottom here, I put, in the case of extreme momentum, add into target 1. So this is really where I am adding. Very few times I'll add on C setups, but B setups, you really want to add into target number 1. If there is a lot of momentum, you really do want to add to normal position size into target 1, because that's really where you're going to see that if I'm proven right, this is where it's going to also pivot. So you enter at the pivot, you get good positioning power, and then you get to target 1. That's proving you correct. And so when your trade idea is proving you correct, let's see if we can get target 2, right? And that's kind of the idea you want to put in trust your intuition beforehand. Now, the A setups right here, max position size. What I typically do is 3 times my normal position size. Now, this can actually go larger than that. I have done larger than 3 times my normal position size on very few trades throughout the year, but it does happen. And the reason I put 3 is because I know there's a bunch of YOLO demons, so I'm not going to say that a whole bunch. But what we want to typically understand about these A setups is these are the ones that when you find them, when you know they can get running, they're the ones that really, really, really run. And so what I try to kind of get across to you guys is that we too, for A setups, can enter with 1/3, 2/3, or even normal position size. But what's really going to define a big trade is your adding. Your initial position sizes should never be that big, no matter what, whether it's an A, B, or C. But when you do start to see it work out, that's when you add. You add only if it proves you correct. And so in the case of extreme momentum, you can consider adding into 1 and target number 2, because again, A setups are the ones like backs where I was kicking myself that I wasn't adding more to it, even though it was facing extreme momentum here. And so in this case right here, this is a case where you're like, okay, I should have added more to this, because again, I had like December 21st or no, the following Friday, I had the 24th contracts that we had outlined. So in that example, I should have been adding more as this started to gap up out of that into that Friday's expiration on the 24th. I did not. But again, some of the bigger examples of this, I can tell you that one of my biggest trades of the year, I added around 12x my normal position size, and that was in February 28th when gold made the all-time high run back in February 28th here. The line's still there. On February 28th, I entered, and then I added up to 12x my normal position size at the time, which, do the math, I already said my normal position size, but this went around 1,000%. So I was adding very aggressively into this trade, and it just compounded and compounded. And these are trades that you see very rarely, right? That we wanted gold to all-time high. We saw the momentum. We knew it was going to happen, and that's just something you hold. So into March 15th, 1,000%, 12x. But that's something, or 12x my normal position size. But I added into it. Notice how I'm not averaging down. I'm not buying losers. I'm not hanging on to ideas that haven't been proven correct. That is the key with these trades, is not only do you separate them from bad to good setups, but also when they do prove you right and they do prove your thesis correct, that you add into them and that you still understand the risks of them, such as see like, oh, this is a highly speculative trade, but hey, maybe if it does, add into, if it does go in my favor, maybe I add a little bit to that. And so there are very rare times where C setups will become where I start adding aggressively to that. I would say that, something like Carvana, that could have been something, but it's just something that I typically don't do. And, some people would say different and tell you differently, but I typically only add to those setups that not everything matches, but I have a lot more data to support and that I know can move a lot more given the context of it. So these are how you should be thinking about your entries and exits and systems. This is how I execute trades. This is how I approach the market. I'm always entering with smaller position size and I'm adding up to my normal ones as they prove me correct. The distance between the adds often varies, but often the rule of thumb is that target number one, which is the next liquidity zone above, our entry or our pivot, is going to be the first add. And then also based off momentum, how much momentum is it steaming up? Is it going drastically in our favor? If so, I need to add because we only get so many chances at bat to hit these big trades. I can't stress this enough, especially working alongside some people who have made, let's say, a lot of money in the markets, that these great traders, even the ones that you'll study, the biggest kind of portion of their P&L is just crafted from just a few trades. I'd say under 30 or 40 trades have made up majority of their P&L. Why? Because they've gotten so good over the years of kind of categorizing these different trades, seeing when an opportunity is there, having the experience to recognize that this one doesn't come around that often, and then being able to position and add into that trade because they know the kind of context behind it and they know what's at stake if they don't. So it's not so much that you guys just suck at trading. It's that a lot of you are taking losers and letting them be bigger than those winners that you should be adding more to and that you shouldn't be averaging down on. This far into the video, I've given you basically all the puzzle pieces you need to go out, hunt, and build out your own profitable trading perspective, from journaling, how to build that strategy, and ultimately how to execute upon it. It is not easy to be a $120 trillion global market. So how do we go about and implement these concepts into the real world and actually beat this market? Well, lucky for you, I'm not just some trading teacher. This coach does play. And so for the remainder of this video, I want to go over some of my research reports. I'm the founder and creator of the RADER Report. It is where I publish my professional research, trade ideas, and actionable information to retail and institutional clients alike. And one of the best things about it is I archive all of my weekly reports over the last year and a half that I've been doing this. So you can go back and see, hey, what did RADER think during this week? How did he play it? How did he position ahead of time, given the factors that were in front of him? And so today I hope to give you a little bit more repetition to not only see that I'm not just preaching to you factors that sound good, but that they actually work and that you can implement them into a real world to beating this large $100 trillion market. So when you log into the RADER Report here, you will notice that there's 3 different reports that I do: a seasonal report, which we've already kind of shown in this video, the monthly report, which is a monthly basis, and also the weekly reports. I want to show a few of the weekly reports from moving forward in time so that you guys can see from week to week, how do I actually build these different perspectives? What ideas am I creating? What am I worrying about? What am I looking at before the week even starts? And of course, I do all my research on the weekends and I publish these every single Sunday. Here it will show you the last 20 weeks or so. While there are more, you'll just have to email me to request a certain week and I will email you that report. However, for data purposes, to not blow up my website, I simply only store the last 20 weeks or so. That being said, right here, you can see that we can just start from, let's start right here. Boom, November 17th. Let's see how I go about and view the market. So first of all, as you go into this, remember that when I'm making these trade ideas, when I'm trying to find things, I'm always building out this funnel. I'm saying I'm going to start with the context and I'm going to create a narrative. I'm going to talk about what is that general market context and what is really the broader thought of the market. And then I go through this report and I narrow it down and I show you directly what I find based off of that. So I'm not going to sit here and read the entire report to you. I do want to read the market context so you kind of see where I'm looking at. What am I thinking about when I create these initial kind of market theses to guide my thinking throughout which trades to actually pick. And so again, this is really the market context portion of a funnel. And so right here, I say market introduction. Another sell-off from the high has investors and traders around the world worried about the future of equity markets. With growing economic pressures both in the US and China, it seems no areas of the market are safe. However, despite the major concerns, data suggests that the long trade may be the wetter one into the end of the year of what has been a historical year. And so at the time of this report, we can just go back to the markets and I'll kind of show you what I was looking at when I was writing this report. So November 17th was right around here. So this was the week that we were starting. And we looked at data and said, hey, you know what? It's likely that the long trade is still going to be the better one despite these kind of pullbacks in the market. And so what data was there to support that? Well, let's talk about it. One of the best guides to navigating the uncertain market expectations this year has been seasonal data. Following the major September quad witching date, which is, again, where options and futures all expire on the same day, trillions and trillions of dollars are expiring that day. We talked about those options expirations. Markets began their scheduled rebalancing as firms repositioned for the next year. This massive rotation fuels October's volatility, but in the majority of cases resolves in a market bottom. Following the early November optimism and pullback, where we are now, seasonal suggests that this week and next will present a strong buy the dip opportunity. I believe that this dip buy opportunity into the end of November offers the better risk to reward trade. Current rotations also support this thesis, as markets seem to be finalizing the move into defensives and value names, which should encourage money to flow back towards growth. While there is a bearish argument due to the current downside momentum from a technical standpoint, majority of key data points disagree with any major sell-off beyond 580. Even glancing at the put-to-call ratio, there was a large increase on November 14th in put orders. This large influx of hedges on the 14th suggests the majority of people are shorted on the day before the bigger drop, putting most of their hedges in the money. This creates negative gamma, which can trigger larger bullish moves of a slowdown or crush of volatility. So far in this kind of what we considered to be important factors, we talked about seasonals. Again, that we've kind of explained that in the video, that into the end of kind of the month, right here, you can see that we expect kind of a buy the dip opportunity, that there would be a decline here and that you can, or some sort of chop, but ultimately it would resolve in a positive close into November based off of the seasonals here. And so we also said, you know what, looking at the rotations as well, that all these seasonal or all these defensive names have already popped. They're going nuclear. And so we really want to say, okay, is there a trade in that? What's going on there? But also that we want to prepare for the buy the dip opportunity. And most importantly, what I kind of mentioned here was I said it would really go no lower than 580. And the reason we were thinking no lower than 580 was because, well, wait a minute. Everyone was shorting here on the 14th. If you go and you look at the put to call ratio, you can see that on the 14th, you had this massive spike, right? In that all these people came into the market and shorted the market. And then when the market drops, all their puts go in the money. And this is a situation where, well, wait a minute, right? If you go all in the money, everyone shorted, then that's going to cause a little bit of more difficulty for the market to actually try to drop into that. So we said really no later than 580. That was the huge put wall at the time. And that was kind of our thesis. Now, what about positioning? You know, we talk about this next portion of kind of, hey, I want to talk about what trades am I looking at? This is, again, kind of moving down that funnel here. We can say position for continued but dampened downside pressure in the first half of the week, followed by a stronger bullish reversal into the second half. In the first half, going long defensive as well as the laggers within sectors like healthcare, industrials, and consumer staples will present greater opportunity. In the second half, starting positions in the trend leaders, such as software and transportation, will present the bigger moves off of 580 to play the continuation down into 580 tag. So basically how I divvied this up was, well, wait a minute. We have a lot of downside momentum. And if you remember earlier in this video, I talked a little bit about the different technical principles, the kind of different momentum, right? That, well, wait a minute, you don't want to necessarily buy the dip in something that looks like this. So I said in the first half of the week, we expect to slow down in selling pressure. And during that time, we can still expect defensive stocks to do pretty well. But in that second half, once that selling pressure has relieved, it's really going to be growth that takes the spotlight, because that's when the buying pressure is going to come. So with this much technical momentum, it is a bad idea just to go and sit there and buy. That never works out. Even look here, right? We had a big selling pressure day. It takes multiple days to resolve before that bigger move. So this is the exact same thinking we had. And so what I did was I went and I found trades according to that game plan. I said, look, defensives are still going crazy. They're still really strong. And so while it's not necessarily the time to long growth now, that's going to probably come later into the week based off what seasonals are telling us. And so what happened was I went out, I found several different trades. And this was kind of my SPY chart at the time. You can see no lower than 580 is really what we're looking at. The weekly attraction, which is where that big level of gamma was at 583. So we were saying we're likely going to stay somewhere around here. 580, somewhere around there is going to be the dip buy opportunity. And the opportunities I found were Hum. This was a healthcare name that kind of seemed to have a liquidation. It was slowing down its pressure. I wanted to see some upside in that. We also had PFE here. This was Pfizer. Then Coca-Cola. We'll get to this trade in a minute. This was, I believe, the trade of the week. And then we also had FDX and some other guys like here. So first of all, let's talk about the two trades that I had within healthcare, HUM and PFE. These two trades kind of were side by side in that there was a few options traders that were betting on these to go to the upside. So there was a few flow orders. I don't always show them, but most of the time I do based off how much space I have or something like that. But as far as PFE and Hum, these looked like they had the best reversal setups. This one, PFE especially, had what seemed to be a liquidation. after such a large increase in volatility, you had this huge condensing of the range. And what that does is actually crush volatility. And what it does is most of the time causes shorts to come back, right? That puts start to lose value. Market makers come in, they start to buy shares back. You know the drill. And so what we had was kind of a trade long over $25 in PFE. And if we go look at this kind of idea here, you can see over $25, this was a major pivot level. And again, this was capitalizing off the context of the market that, hey, wait a minute, in the first half of the week, we expect healthcares and all these guys to get the bigger rotation. Again, following that kind of seasonal period and based off what the rotations were telling us, and even the put to call ratio that, the more beaten down names are going to be the better name to bottom first, or the best name to bottom first, right? That we had this boom initial bottom, the laggers are going to get bought up first, and then it's going to be the leaders who get the bigger continuation. And you can see right here, I talk about that wait a minute, right here in the kind of thing, I said that in the second half, starting positions in the trend leaders. So we use that rotation principle I showed you today that, well, wait a minute, the laggers, the ones that get beaten down the most are going to be the best first initial dip buy in the first half of the week. And then, of course, the second half is going to be where the leaders really take control, and those are going to be the growth names. So what we did here was I created a game plan. I said, you know what? The timing aspect is more important to me. So the first half, I'm going to do this. Second half of the week, I'm going to do this. And so PFE and HUM were two trades. HUM, I remember, I don't think this one worked out as well. Yeah. So this wasn't as good of a trade, but you can see that it did pop a little bit following our kind of 14th, it eventually moved. But that was not a trade I actually made money on. So full disclosure there. But as far as this one right here, this was the big name that I had. This was Coca-Cola, trade of the week. So right here, what I observed was, okay, if the first half of the week is expected to be bullish, or at least in the defensives, we expect that final continuation push in the defensives before growth start to get the majority of the money. Then right here, what you can see is that, okay, I was scanning around and I found this name, Coca-Cola. Not only during this period do you expect a better seasonal performance from Coca-Cola, which is rare. You can see really the rest of the year, you don't really expect all that much. But all of a sudden, this little pocket of space is where Coca-Cola tends to outperform the markets. And so that's something to look for. And when I said, okay, you know what, this is interesting. And when I went and I looked, this tool, of course, is on the RADER report. But when I looked at the other tool on the RADER report, which is, of course, the open interest, I could see that this was a beautiful setup. So check this out right here. What you have is a stock price right here. All of these options are what? All of these options are out of the money, at least the calls. The calls are out of the money. And what you can notice is that this put is the biggest put level on the entire options chain, and it's in the money. So what here, you're in no man's land. You are in an imbalance where all the calls are out of the money. No one is getting paid in the calls, but the puts are all being paid. So the puts are the only one in the money. That is kind of in a balance because none of the calls are making money. That means, well, wait a second. If we talk about balance, then wouldn't it be best if the market makers kind of position this elsewhere, or that the markets found equilibrium kind of higher into this area here? And that's exactly what happened. Not only that, but we typically look for this specific structure of what's called an ascending call wall. This acts as a liquidity attraction to 65. While 65 was outside of the expected range for the week, we expected it to close somewhere in there. So when we looked at KO, we said, you know what, this is a similar setup to Pfizer in the sense that the buy the dip trade is likely going to be in the laggers first. This one's beaten down. If defensives do get their final rotation, then Coca-Cola should be the one that benefits from this as well. So this was one that I liked, and I said, you know what, anything over 61.78, we'll grab calls targeting 63 or 62.65. And again, this was a trade going back to the executions that we wanted to add into target one, right? And that wait a second, add into target one, any momentum, based off momentum, we can even add into target two. This was really an A+ setup for me. But that's kind of that. So if we go and we look at what happened to KO, you'll notice, well, holy smokes, right? That all of a sudden, above that 61.80, which is where we entered, this thing absolutely rocketed. So it did actually go to 65, just not that week, but it rocketed up towards that level. And this was an idea, again, around that thesis. We create this market context. We go down this funnel. We look for, hey, what are the rotations and seasonals? Okay, they're favoring kind of those defensive names, and that in the second half, then we can position into growth. And then options market, there's an imbalance on Coca-Cola. There's also kind of that seasonal advantage, that pocket of seasonal strength we expect, and that we can say, hey, you know what? This is an imbalance. We expect a correction. And then we go look at the technicals. This is when we go and look at the technicals, is when we have this idea. And once we have all these ideas already, that validates why we would kind of expect some sort of long in KO. So KO, the technicals were great. We expected, hey, maybe a chop in the first, but ultimately a reversal here. The technicals were awesome. We love this. We created a pivot. We created a game plan. That's how you do it. Now, additionally, there was FedEx and ZS. FedEx was a second half of the week trade, if you remember me talking about. So if we go look at FedEx here, this one also, again, in the second half of the week kind of benefited. So you can see past Wednesday, this was the trade. So everything is about timing, and timing was what paid here. So this was ultimately what we played on FedEx. And again, we were targeting, 1/3. And you'll notice me even use this here. I said, however, if this occurs Monday or Tuesday, assuming that we cross over this Monday or Tuesday, I'm only going to enter with 1/3 of my position size. So this is, again, kind of going back to that rule that this is not an A+ setup for me. So I'm only going to enter 1/3 of my position size if it does happen early. Because what I'm saying is it's not necessarily meeting my exact criteria, so I'm going to reduce my position size on it, but I will add into it on any significant amount of momentum past Tuesday. But that is exactly what we did there. So FedEx, again, everything is about timing. You'll notice all my discussions here are about timing, about how I enter these trades from a timing perspective. And you can see ZS here, it didn't do all that well. But at least from the 14th to the 15th, it kind of sunk down a little bit. Not too crazy there. Now, let's go look at another report. The one we just looked at was November 17th. So we're going to go to November 24th. And we're going to see how I carried over the knowledge from last week and carried it and put it into this week. And again, there are some great trade ideas we'll look at here regarding Roblox and some other guys like this. So let's go take a look. So first of all, I'm going to read you kind of this market thesis. I think it's important because, again, you need to see the context of the market. How am I framing the market? How am I building out my trade ideas when I go and I do this? So first of all, let's read this. With the seasonal top nearing, the bulls seem to be setting the stage for the final act from the October bottom. Historically, markets tend to have a melt-up across several major asset classes into late November and early December. The final push of optimism tends to benefit small caps and short squeeze style names the most, along with other beaten down sectors that did not get picked up throughout mid-November. It isn't just history that helps guide our trading expectations this week, however, but also the imbalances shown in the present. So what I did first was I kind of framed that, well, let's capture what historically happens during this time period. It's that November and December, typically, mechanically speaking, they have a big push into the smaller caps and the more beaten down names. The guys that didn't get the massive run up from the October bottom, that's just mechanically what happens. That's the laws of rotation, that once the big leaders get their rotation, they come back for the little guys and they drag them along up to the top as well. So moving on from that, I talk about the imbalances. Okay, let's see what I saw here. Several key small cap stocks in beaten down sectors have developed abnormally high short float or put option imbalances that could lead to a large wave of covering across certain market pockets. But even as flammable as gasoline is, it still needs a match to start the fire. Ooh, I'm cooking with the metaphor there. The rotations last week could very well be that. With a strong close in healthcare, small cap material, and industrial names, it seems firms are selling big growth to reposition elsewhere. So remember last week we longed PFE, that worked. There was a lot of healthcare names and defensives that did really well. So I'm carrying over that information into my thesis this week. Current data suggests that will likely continue into next week. But the wave of short covering and rotation into beaten down sectors aren't the only ideas traders need to watch out for this week. Inflation is also another theme dominating the horizon for equity markets. Remember, in market context, we're trying to find themes, and inflation was one of them. Over the last 2 weeks, expectations of the market has drastically swung back into the direction of a pause coming to rate cuts sooner than expected, bringing commodities and material names back in the front line of opportunity. Why? Because if the market's thinking about pausing, again, you'll learn this through Barron's, Wall Street Journal, you'll get exposure to these ideas. If they're expecting about pausing earlier than expected, then that would bring the inflation expectations worse than the market had priced in. And of course, that would benefit a lot of those commodity names and whatnot. On November 13th, the future swung from 80-20 probability in favor of cuts to nearly 50-50. While this is expected to swing slightly throughout the week, the sudden change in expectation could be enough to dampen the dollar and provide massive relief to commodity and material names. I believe the better trading opportunities this week will be the long side, with common short squeeze names in selected beat down sectors. Additionally, I believe there is a large opportunity in preemptive rotation into inflation names. So basically I said, look, despite all these concerns of inflation, yada, 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 I still think the long side trade is the best. Okay? Now, as far as positioning,
Continued for optimism throughout the holiday week, with Monday and Wednesday showing the most consistent gains historically. Small caps, materials, commodities, etc. So notice how I said this holiday week. Mechanically speaking, here's another tip. During holiday weeks, you can actually expect more bullish flows because with the less volume, you can actually expect it to be even more supported because, well, the less volume carries typically a bullish pull to the upside. So that's that. Now, as far as building context and everything like that, again, we're going for market context, seasonals and rotations. We talk about, you know what, during this week, it seems to be pretty split that you expect maybe one more leg up in the market and then a drop into the end. That's typically what happens into the end of November. So right here, we looked at the flow of capital. Again, just defensives all seeing kind of that swing around from last week, that continuation, and growth still lagging. So we were kind of saying, hey, you know what, this might be the final act, things like that for that. Now, the first trade was Roblox. This was a trade I was looking at. Again, remember, the theme is beaten down growth. We want to find names that kind of have that big short float or that have been heavily shorted, things like this. Well, right here, this order was a hedge order. This was an order I found. This is an A+ setup. And so what we had here was a flow that meets all the criteria I look for, massive hedge orders. And what it was buying the dip. We were having to buy the dip opportunity. We wanted to buy off of 47.75, somewhere here, targeting 12.6 or slightly longer expiration. I went for the 12.6 expiration here. And what really kind of kicked off this idea was, well, again, short float trades will likely be heavily shorted names will likely be the names that really get a pop this week because in the final stage of a bull market, the names, the craze names start to get a pop, right? So after October, into November, into the end of December, whatever, early December, we expect that final massive rally to start to slow down. And what's going to happen is that money's going to rotate into those deadly short squeeze names. That's typically what gets a pop towards the end of that. Now, if we go back in time and we go look at Roblox, how did this perform? Well, all of a sudden, you get this massive here. Now, I created this during a different discussion I had not too long ago about this trade, but this was one of my bigger trades of the month of November. So we had 48.29. He buys here. They go in the money. He crushes volatility. So notice how he placed all these orders on the 21st. So he bought right here. As soon as he placed his orders, it just crushed volatility. And what happened was this started to curl up. And then once it hit our entry off of that, of course, 47.75, somewhere there, you could have entered there. I remember I specifically started to buy into this 49.60. But this right here, into this $49.60, $50 area right here, this was where the pivot was. This was where kind of that crush of volatility was expected to happen. Puts start to lose value. You get closer to week of expiration, massive rally. So this trade went nearly 1,000%. A crazy move. And again, this is a big hedge following that already big move, which kind of set the bottoming tone for us. So again, option flow not only helped us time the order, but it also did help us get a direction that, hey, you know what, this, boom, boom, boom. But again, the only reason this option flow works is because I understood the context of the market. I knew what tickers to look out for. I knew what fit the narrative. I knew what was going to likely get the bigger rotations, and it so happened to be Roblox fit the bill there. So that was the trade of the week, or not the trade of the week, but my biggest trade of that week. The trade of the week, which is just, I kind of do a silly trade of the week every week, was going to be silver. This was just based off of playing that kind of inflation idea. So if we go and we look at, I believe it was the week following the November 15th. So what week are we looking at here? This is the week of the 24th. And so if we go to the start of the 24th, you can see right here, this kind of set the bottom. We had this massive drop, but eventually clawed back to the high. This was just turned out to be a nothing burger. Silver and all these other guys, they didn't do too hot. There was a massive put wall here. This could have been an entry at 27, but we just didn't end up liking any of that. So silver was a discussion of that, but this was an idea playing long over 28.46. That never happened. We never got an entry, and so we didn't take this trade. But again, FCX, this was another one. So FCX was an interesting trade as well. This one ended up being a nothing burger. But what I wanted to show you was that, throughout this, we kind of talked about, hey, you know what, that this, pivot, we want to see this. But again, I'm not adding heavy into this. Notice how there's no supporting data other than the fact that I just like the setup, that it fit the kind of inflation theme, whatever. that this is not going to be a trade I'm adding huge size to. I'm not going to add down on this. And so we kind of highlight, this trade becomes invalidated underneath of this level. I'm always setting these parameters. And I said, while buying the dip likely won't be worth the risk, it is an area to expect buying pressure from. So I'm even saying, hey, you know what? This is a really risky trade. If it does hit 43, it's probably not worth buying the dip. But you can expect buying pressure off of that level. So it ended up not being really that great of a trade. We had it go into target 1, but not enough momentum following that. And other than that, it was just nothing there. FSLR, this was an interesting one. So this one was kind of betting on the short squeeze names and to get a big pop. So this was 186. So if we go look at this one, this had a kind of massive grind higher into that following Monday. But again, we were targeting calls for 12.6. And we said, again, look at the risk. Entering with 1/3 of my position size initially and adding to full position on the golden zone. So I was like, hey, look, if I buy the dip, I'm going to only enter with 1/3 of my position size because I don't want to risk that much. But as it came into that golden zone, you got that big pop, and we grabbed 12.6 calls. So this one did work out. It had a nice big run up there. But again, trying to find those kind of short squeeze names. CRISPR was another heavily shorted one as well. Oh yeah, this one did work. So CRISPR was a big one as well. This one had a massive day, a massive few days. Again, 12.6 calls on this one, really big. And again, you can see $2 move, 12.6 calls at the money, yada, yada, yada. And this was, again, targeting that same theme, 22% short float. So this was a good trade as well. I remember that one now that I actually see it. Alta, this one right here, huge run up into earnings. We also talked about this. The Alta has earnings coming up with adds to the bullish thesis, and this one right here, boom. So this was the Monday 25, really big run up into this. I actually don't think, the reason I'm not remembering this one, I don't think I had that big of a position size in this. This was not an A+ setup for me or A setup, whatever, but I did, I believe, add a few into that. But Roblox was the definite trade that dominated my memory for this week because that was such a big one. But Alta, huge run up. But again, timing, right? Timing is everything. We see that into the 21st. You have this beaten down Alta that's compressing volatility. We have earnings in just a week. Let's go long. Let's find out if we can get a earnings run up here, which typically happens. So that's that. And we'll go over one more report here for the first week of December. This one right here, of course, coming into a holiday season. Let's start right off the bat. Again, let's start with the market context. How was I framing and building out a kind of thesis for the market? With Thanksgiving out of the way, December is finally here. The markets can finally start to trade the sound of Christmas music. But with all the festive cheer, are the markets going to maintain their optimism? Well, data suggests that there's still plenty of upside opportunities to capture. And so I kind of gave a little hint to my kind of thesis, but let's get into why I think that. In the wake of the October seasonal bottom, several key sectors and assets have continued to rally, such as crypto, defensive stocks, and even bonds. However, some of the biggest players like mega caps and other growth industries haven't found their footing yet, as QQQ lags the S&P 500, so that being technology. But over the next 2 weeks, data suggests this could change. Seasonal expectations, again, now we're trying to transition into seasonal expectations. We're discussing a little bit more of that context. Seasonal expectations point towards significant outperformance in certain technology, Russell 2000 and industrial names until the second week of December. But historical price action tendencies aren't enough to justify a move. So again, I'm referencing seasonals, but I'm saying, hey, look, just because we did this during certain periods of time in the past doesn't mean it's always going to be a concrete fact. And so is there data to support that outside of the seasonals? Transitioning from last week, the rotations in the market seem to actually be moving away from the defensive names that it was favored since October. So remember how we were kind of like, hey, Coca-Cola last week, boom, these other defensive names, let's long those, the short squeeze names, those kind of names. We transitioned that into this week and say, hey, how was that? Well, is it still around? Is it still present? Is it changing? Currently, a decrease in momentum across defensive names and a pickup in several growth sectors have the upside finally looking to be the better risk-reward trade. So if you remember last week's, we were longing Coca-Cola. We were longing healthcare names, more defensive picks. But all of a sudden, I said, hey, look, that's now changed. A lot of those growth names have popped off the low. The momentum is favoring the growth now. And so we're going to shift our kind of focus to there. With technology lagging, several of the major industries such as semiconductors have become heavily shorted, which could further add fuel to current growth rotations. Shorts coming to cover is a large put walls could force market makers to buy. So a similar theme, but now we're just shifting our focus to heavily shorted growth names and things like that. For bears, the bigger shorting opportunities will strictly come down to timing as we approach a key pivot date on the 6th, known as max pain, which is again 14 days before quad witching. That's something you guys don't know, but if you've known me long enough or you are in the Discord as a member of the RADER Report, then you will certainly know that. With momentum at all-time highs favoring the bulls and bears continuing to hedge each drop, the risk to reward only increases following this week's closing bell. And then as far as positioning, I said position this week continued upside in semiconductor, solar, industrial, non-transportation, small caps, and mega caps. To the downside, stick to stocks outside of these sectors, industries that closed towards their lows last Friday. So only short things that are extremely low. Going back to that technical kind of slideshow I showed you, picture the week closes. We only really want to short those guys because that's going to give us the highest percentage chance that we actually catch some downside. So again, we review kind of the different seasonals. I always give playbooks. I kind of mix it up. Each report is new. Each report is fresh. I release before the start of the week. And you can see this week, we typically get a big pop into December. Now you can see right here, again, analyzing the rotations, mixed bag, but overall the growth rotation was really the dominant one. And we can see SPY right here, kind of, hey, you know, we can expect some sort of parallel channel going up as it starts to slowly grind higher. Now the trades this week were quite interesting. One on CATS. We also had one on ENPH. SMH as well, AVGO, which was probably the biggest one, in INTC. Well, I'm not going to go through every single one. What we can talk about is going to be just a few of these. I'll just pick AVGO, and we can just roll with this one and a few others. But this one right here, AVGO, this one was very, very interesting. Again, trying to catch the kind of shorted growth names was the theme this week. And we had AVGO, huge put seller came in right at the close of the market, targeting 12.13 at a major pivot level. What this is likely to do, especially this large size on a stock like AVGO, is cause market makers to begin to buy equity to actually hedge. If someone's selling puts to open, it means the market maker is going to buy equity to hedge, not short it. And so what you actually expect is quite a large reversal against them. First week of December, you can see right into earnings, we had this massive pop, and we had this big move all the way up to 174 from 161 on AVGO. And again, that was a heavily shorted growth name that had this large put seller come in. So this was more fuel to the fire. We also had semiconductors as a whole, right? That semiconductors were heavily shorted, huge imbalances across the board of puts, and that we really wanted to long anything over that 512 of that week. You can see if we actually go look at QQQ, while this was kind of a QQQ chart, the actual trade was SMH. And if you go look at QQQ or SMH on the first week of December, these names absolutely went nuclear. So the first week of December, these went absolutely crazy. AVGO, all these names assisted in the semiconductors rallying. But again, this kind of idea of framing the market with market context, breaking down all the data is what I present to you on the RADER report. I say, here's the reasoning behind my thesis. Here's what I'm looking at. Here are the important factors and why they're important. And then we move down this kind of funnel, and then we go and I show you the technicals, but the technicals are kind of the last kind of picture that we look at before we decide a trade, because ultimately what matters is, are the trades we're looking at relevant? Are the trades we're looking at important to the current market context, to the rotations, to the seasonals? Can they actually move if they were to get going? That's what validates technicals. That's what gives them their resume. I could sit here all day and lecture you guys about my different trade ideas and all this other stuff within the RADER report, but it would take me hours and hours. There's so much material on there. So I'd recommend you guys go sign up for that. I think it's a bargain for what I offer, and I set out to make it a bargain for what I offer. But not only that, make it the highest quality possible. When I set out on this journey to not only publish my research, my trade ideas, things like that, I did so because I wanted to have the most actionable, the most detailed, and the most professional research out there. I cannot believe it, but when I stepped into this space and looked at other people's, some of the biggest research firms in the world publish the most generic information. I'm talking about MACD analysis. Yes, that's real. And I did not think that this was a really ethical, but also a really sound way of investing in the market. Now, if you want to get super involved, if you are a member of the RADER report, you can also get access for a separate charge to the Discord. This Discord has my mentors and I in it. Yes, my professional mentors that trained me in the Bay Area. We originally used this Discord to just contact each other when I was moving away from it for school and things like that. But we slowly started to open up to the RADER reporters over the last year because my mentors really do love sharing their knowledge for the markets, so long as they didn't have to on social media. I wouldn't force them to do that, but they agreed to do it over Discord and share different calls, things like that. So there's hundreds of hours of PDFs, hundreds of hours of videos in there, and you can get involved in different discussions. We do mock hedge fund trials where you can work with partners, and we run you through how to do like a hedge fund and what decisions to make, etc. There's group work, there's weekly assignments, and yes, there's homework that you're expected to do. So that is for the ultra committed. I put this at the very end because I only want those who are super committed to actually signing up and knowing about this. I'm not here to make money. I'm just here to unite the best of the best in this industry and those willing to actually commit and learn something this advanced. So without further ado, guys, thank you so much for watching. If you want to support this channel, please consider subscribing, support my work by signing up for the RADER report, but also have a great rest of your day, guys. I hope all of you safe travels wherever you're going. Drink some water. Bye-bye.